glass will unify user experience across all its devices, from iPhones to MacBooks. As part of its rebranding efforts, the company also confirmed that it will use years, not version numbers, to identify its software. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the US and China working out a deal.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
Up next on the program, we'll catch up with Henrietta Trays of Vader Partners, live from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Quiet start to the week so far. Muted gains yesterday, this morning, just about unchanged on the S&P 500. Likewise on the Nasdaq 100. Under surveillance this morning, the US and China working out a deal.
We are doing well with China. China's not easy.
Did you give your negotiators any sort of limitations?
We're going to see. Look, China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason. They didn't want to do it.
So here's the latest this morning. A second day of US-China trade talks continuing in London. On his way into Lancaster House, Commerce Secretary Howard Lutnick telling Anne-Marie he expects the talks to go on all day today after saying they were fruitful just yesterday. Bloomberg's Tyler Kendall is with us from the nation's capital. She's in Washington, D.C. Tyler, do we know exactly what happened yesterday and why this has gone into day 2?
Yeah, hey, John. Well, I actually was pretty struck by what Kate Kolukowicz, the former Trump trade official, said on this program earlier, which is that if the goal here is ultimately to get to restoring the agreement reached in Geneva, that should have happened relatively quickly. So perhaps that these talks have extended into a second day. That indicated to her that one of the sides here might be dragging its feet. Now, of course, we haven't really gotten any details on exactly which side or which of those issues could be the hang-up here, but we know that at the heart part of these negotiations is that both countries have imposed restrictions on products that the other country relies on. And that really does come down to these export controls. Now, as you heard there, I tried to press President Trump yesterday at the White House if he gave his negotiators any sort of limitations when it comes to export controls, and he didn't rule it out. And our reporting does indicate that the U.S. has signaled a willingness, perhaps, to lift some of the recent restrictions put in place, but that would, of course, come in exchange for China pledging to give some sort of reassurances when it comes to speeding up the export licenses related to critical and rare earth minerals. The U.S. has signaled, people familiar tell us, that they would focus on those recent restrictions that have gone into place, such as on jet engines or the software used in chips. Now, of course, John, it probably goes without saying that these talks are, of course, incredibly high stakes here. It doesn't really seem like we would get some sort of lowering of tariffs at the end of these conversations in London, but it's probably a good reminder that Bloomberg Economics finds that the levies that are currently in place could cut U.S. imports from China by 70% over the medium term.
Well, Tyler, you mentioned some of the language coming out of U.S. officials. What have or haven't we heard from China, and what does that suggest on how likely they are to accommodate some of these demands from America?
Well, Danny, there definitely seems to be a more tempered tone here, and they have been pretty firm that they want to see the U.S. lift its restrictions. That's sort of the line that we repeatedly hear from Beijing when it does come to these talks. And there's been a lot of focus on the fact that Commerce Secretary Howard Lutnick is included in these talks, and perhaps that does signal a willingness to put these export controls on the table. But we also have to keep in mind that Howard Lutnick at times has indicated that he has a pretty hawkish stance when it does come to China, telling lawmakers last week that he wants to see a tighter enforcement when it comes to those export controls. And Danny, there's of course a lot of other sort of extra things on the table here that China has raised concerns about, including U.S. plans to revoke Chinese student visas. And even as we did hear President Trump last week say that Chinese students would be welcome here in the U.S., it really remains to be seen if they're going to fully roll back that policy and whether or not that would be enough for China to get on board with the broader deal.
Tyler Kendall with the latest down in Washington, D.C. Tyler, thank you. Joining us now to continue the conversation, Henrietta Trace of Veda Partners. Henrietta, welcome to the programme. So this was framed quite simply, yes, would push to drop some restrictions on their side in order to ease the limits on rare earth shipments from the Chinese side. Now, I guess we've got two options now. Either that's proving more difficult to do as we go into day two, or they're shooting for something much bigger than just that. Is there reason to believe it's one and maybe not the other?
Well, I'd like to offer a third alternative and connect a few dots here. I don't think we're talking about tariffs anymore. And I think that's something that the street is coming to understand right now, and China has already grasped, which is that when we got a CBO score suggesting that these tariffs that are in place today are generating $2.8 trillion in revenue, and the White House starts immediately putting out memos incorporating that threshold into their public presentations on the state of the tax bill and the reconciliation package, we're not negotiating for tariffs to come down. The tariffs that are in place today are very likely to continue across all nations, not just China, but Japan, South Korea, the EU. And they're going to also see sectoral tariffs on pharmaceuticals, semiconductors, trucking, aircraft in the months ahead. So what's being negotiated are the extraneous issues that, of course, since the Geneva meeting, both sides have ratcheted up, whether that's on limiting student access to the United States for Chinese students, or the Huawei chips, or AI, or rare earth magnets. They're expanding the scope of this war and no longer negotiating just the tariff rates. I think that they're looking for an excuse to get past Liberation Day, which in this case is in August, and come up with any reason to keep tariff rates where they are while they fight on different fronts.
Henrietta, can they use tariffs as a crutch then? Can they use the tariffs in the negotiation? Or are you suggesting that they are just completely to one side, they will remain, and that's not going to be touched for the foreseeable future?
I think they can go up. I don't think that they're going to come much further down. 30%, as we all recall, is obviously way lower than the president initially wanted. He gave Bessent the go-ahead to drop rates down to 80. We know that anything above 50% is effectively an embargo on trade, and 30%, cargo is just now starting to get back to where it was before April 2nd or before Trump took office. I don't think they're going to go much lower than 30%. Again, that revenue score of 2.8 trillion is just too attractive. So the threat is permanently there of tariffs rising, and I believe they will on a sector basis. And I was speaking with another former USTR recently, and he suggested that one or two nations could be made an example of, Nicaragua, for example. But for the most part, these tariffs are here. They're here to stay, and we're going to have to fight on other fronts.
What does that say about negotiations with other countries, Henrietta? When the 90-day pause comes due in July, is it your expectation that we also get a resumption of higher levels of tariffs, something like we saw on Liberation Day?
I don't think so for most nations. I think that the administration is looking for an excuse to extend the July 9th date out into the future. I don't have a good sense of how long they want to extend it out into, 30, 60, 90 days. But one thing that I really can't square is that the Liberation Day of 2.0, July 9th, is well before when I anticipate the tax bill passing. So you have this awkward dance between Republican lawmakers trying to pass this bill on the Hill and the July 4th, 4th of July rally that the president is hoping to have, and then the July 9th expiration date. So I think the dates are a little bit fuzzy, and they don't really quite have a streamlined narrative. The tariffs and the tax bill haven't quite blended perfectly, and I wonder whether that might come into the conversation.
There's one more piece of the puzzle at the moment. As you know, the White House increasingly distracted by what's happening on the West Coast in Los Angeles. Henrietta, do you take the point, maybe make the argument that they're much more comfortable with that story developing in Los Angeles, and maybe that takes some heat off the passage of the bill, the tax bill in Washington?
Oh, yeah, they got to love it. And the timing is perfect. Tomorrow or Thursday, the Judiciary Committee is putting out their $175 billion package that is going to spend money on immigration. And one of the things that has been lost in the last week of Elon Musk and Donald Trump feuding over Twitter is that the whole package, the reason we're doing one big beautiful bill instead of two, is because there's a tremendous amount of dessert in this bill. There's $350 billion in funding for the military and immigration, and that's what's going to carry this bill over the finish line. I've only seen one senator come out against those spending levels, and that's Rand Paul. And even he wants some level of spending at $75 billion. He just doesn't think we need the full $175 billion. So I 100% expect for this immigration conversation, the raids in LA, sending in the National Guard, advances my odds that the OBBB gets signed into law.
When all is said and done, how different will that bill look to what was passed in the House?
It's going to be substantially more deficit increasing. I'd say at least $400 billion more in deficits. The SALT cap is not going to be as generous. The IRA tax credits cannot be cut back as much as they have been. This is just a tremendous job growth in key states that need it, including Alaska and North Carolina, where there's at-risk Republican members. It's going to change quite a bit.
Henrietta Trace of Vader Partners. Henrietta, thank you. Something to mull over, think about going into those debt auctions tomorrow, 10-year, day after, 30-year.
Yeah, but all the bears keep looking to the debt auctions and say, it's going to be bad, it's going to pull back. We haven't really seen that. The auctions since Liberation Day, they've been fine. Maybe you can't say the same for Japan, let's say.
Apart from the 20. I'm not sure what,
but the 20's
I'm not sure what a 20-year auction says about anything anyway. I agree.
I don't think we can take much signal from that. The auctions have been fine, but there are plenty of reasons to be worried. The one big beautiful bill is getting passed. And just another thing to throw in there, Paul Donovan saying that the images in LA are worse than it actually is on the ground. And the foreign investor community will look at that and say that there's more dysfunction in US and maybe just add that to their list of why they want to flee American assets.
I asked Lisa yesterday whether we should kill the 20-year maturity, and she said put a stake through it.
Wow, Lisa wants one less auction?
One less auction, one less maturity.
It's very surprising. I think that's the signal right there of how bad the 20-year auction is.
Can agree with you more. Up next on the programme, David Tinsley of the Bank of America Institute on the state of consumer spending. We saw a lot of front-loading. Are we getting the bill for that through this summer? That conversation up next, live from New York. You're watching Bloomberg TV.
Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Two days of gains on the S&P 500. Pretty muted stuff to kick off the trading week. Unchanged so far this morning. Off the low of April, though, higher by 20.5%, and now just 2.25% away from all-time highs on the S&P. This morning, unchanged. If we switch up the board and get to the bond market, BMO's Ian Lincoln this morning saying this: the looming gauntlet of duration. 10-year yields are lower. 30-year bond yields are lower. Going into tomorrow, $39 billion of 10-year notes. The day after, $22 billion of 30-year bonds. That's the next step for this debt market. 2 hours away from the cash open. Let's get back to equities and get you some morning movers with Yahira. Hey, Yahira.
Hi, John. As you mentioned, it is a pretty muted morning, but I did happen to find you some movers. We start with Tesla. Those shares are up 2% in the pre-market after rising 4.5% yesterday, defying 2 downgrades from analysts, including Ben Callow, who will be on our program later this morning. And this, of course, comes as the EV maker tensions seemingly ease between Elon Musk and President Trump, and as Tesla and as buzz builds around its robo-taxi launch event anticipated this Thursday. Meanwhile, next up we have shares of Novo Nordisk. Those are up 3.2% here on an FT report that activist hedge fund Parvis Asset Management is building a stake in the Ozempic maker. And they report that Parvis wants to say in who will run the company next as it faces rising pressures in the booming weight loss drug market. But not booming has been this stock, which has been cut in half in the past year. And last up, we end with Meta rising 0.7%. And this is as we here at Bloomberg report that CEO Mark Zuckerberg is frustrated with its latest chatbot models. And because of this, he is personally building a secret super intelligence team and even holding recruiting dinners at his homes as he tries to assemble the best of the best to achieve artificial general intelligence. So investors hoping that may lead to some real progress. John?
Yahira, thank you. More from Yahira in just a moment. Just want to get you up to speed on some news. Steve Schwarzman of Blackstone sitting down with Bloomberg just moments ago, planning to invest $500 billion in Europe over the next decade. That's pretty punchy stuff, mentioning that Blackstone has lots of money to put to work. Also, a few takes as well on tariffs resolving themselves in, say, 9 months' time and not seeing a great impact on the inflation side.
Yeah, on the short end of things, he thinks it could happen in 6 months, which is really optimistic considering last time around it took 18 months. But that is the kind of thing that moves investors like Blackstone to Europe. We heard from Apollo last week at the conference I was at, Jim Zelter saying that they would invest $100 billion in Germany, just in Germany. So as tariffs take hold, these executives are paying attention to it and are shifting more of their resources to Europe.
That's the latest from Blackstone. We'll try and bring you some of that conversation a little bit later this hour. On our radar this morning, our top story, a second day of US-China trade talks kicking off in London. Both delegations looking to ease tensions over rare earth exports and technology shipments. President Trump saying just yesterday, quote, "We are doing well with China. China's not easy."
He says they're doing well. Secretary Howard Lutnick, Commerce Secretary, told Anne Marie that they were doing well this morning. Bessent called it a good meeting yesterday. But what you're not hearing is the Chinese delegation giving comments. You're not hearing much from them saying things are going well. What you are hearing, for example, a strategically and very well-timed placement from the Huawei founder saying that U.S. technology is not that important to us. We have workarounds from things that we would get restricted from the U.S. So it seems like the narrative that China is at least trying to build is we have the upper hand, we can wait this out, and you can't.
Henry Tracer Fader Partners said something else we're not hearing at the moment. I think it's a really important point that we have to underline. We're not hearing about removing tariffs. We're not hearing about taking down tariffs. It doesn't even feel like that's part of the conversation over in London today.
No, it's really not. It's put to one side, and her assumption is that tariffs stay at the higher level. But what you're getting from these negotiations is an administration that's able to move beyond Liberation Day, that can talk about something besides it. But what does that mean for business? Okay, you get an agreement on rare earth metals, that's good for the autos, but what happens if we still have tariffs that look like something like 30%, if that doesn't budge?
That's the latest on trade. We'll have more on that story with Anne-Marie, who's in London. She'll be joining us in the next hour. I want to get you an update on the latest in tech. Mark Zuckerberg is prioritizing recruitment for a so-called AI superintelligence team. Sources telling us here at Bloomberg he's frustrated with AI shortfalls and thinks Meta should be outstripping competitors on artificial general intelligence.
First of all, I love that he's holding dinners and trying to recruit people. Mark Zuckerberg, I'm not an engineer, but I will happily come over for dinner. But it does just underscore that there's this real risk in falling behind. I mean, something as ubiquitous, for example, as Google search gets completely upended by ChatGPT. And that is the risk for Meta. Even though they're already spending lots of money on AI, if they don't do something in artificial general intelligence, which is kind of the next leg up, does that mean that they will have spent billions for nothing? That they spend billions and someone else comes in and completely disrupts them? So they need to spend what is an ungodly amount of money, it seems like, trying to form a moat to make sure that doesn't happen.
Reminds me of the Facebook days. Do you remember when they left the desktop behind and became mobile first, and he basically told everyone around him he doesn't want to hear anything about improvements to the desktop experience. He wanted to be mobile, mobile, mobile. Feels like it's that this time, but with AI.
Yeah, it does feel like that. He's trying to move on. Of course, I wonder what the corollary is of you know, our parents still using desktop Facebook, and I don't know, of that kind of
People still use desktop Facebook?
I think there is a generation that still logs on, my mother being one of them. Logs on. Yeah, she logs on to her Facebook on her desktop and, you know, gives a thumbs up, and I don't know, do people still do pokes on Facebook? I don't know what she does on there.
I'm not throwing shade at Mrs. Berger. Good morning to you. Let's turn to the latest on Apple. Failing to impress investors at its Worldwide Developers Conference, the company announcing it will roll out new software and features like live translation. It is yet to strike any major AI deals and says it still needs more time to bolster some AI elements.
It feels like it is Apple trying to learn of the missteps of their last Worldwide Developers Conference. Because you'll remember they came out pretty punchy with what they saw happening in AI. They talked about Siri, that Siri would be advancing. What happens when you get the open of this Worldwide Developers Conference? It is a delay to Siri. So perhaps it is just a more conservative Apple that has fallen behind and doesn't want to promise anything. Instead is just giving us all these flashy liquid glass or whatever it's called.
And emojis.
And your favorite, the Genmojis, yes.
Yeah, or not. That stock is down again this morning by 0.2% on the year. Year to date, we're down by close to 20%. For shares of Apple. Let's turn to the US consumer. Bank of America releasing its monthly consumer checkpoint report with a read on how tariffs impacted spending in the month of May. Joining us now is David Tinsley of Bank of America Institute. David, welcome back to the program. So you know how much I enjoy an update on this story. So let's start here. We understood that there was a front loading of purchases from consumers ahead of tariffs, and after we saw those big announcements, are we starting to pay the price for that? Are you seeing any sign of that whatsoever in your latest research?
Yeah, thanks for having me back. Yeah, very much so, I think. So in our latest data for May, the card data fell 0.7%. And there are kind of three reasons for that. But up front, in a sense, is that payback. So we saw electronic spending ramp March, April. It fall back to a negative year-on-year growth rate in May. There are some other reasons for that weakness in May, that relatively soft print in May. One was the weather. You know, it was a bit cold and wet, essentially, around Memorial Day. There was also just a broader kind of slowdown across the US regions as well. So I think those are the kind of mitigating factors, I think I would say. The underlying spending growth is probably stronger, and you can see that in the labour market data, I think.
David, I always think these updates are a good opportunity to do the maybe quarterly panic of should we be worried about buy now, pay later? You talked about the fact that millennials and Gen Zs are spending more than their Gen X counterparts. Is there a reason to be worried if that is starting to pick up, especially among a younger cohort, which tends to have more credit issues than, let's say, the older?
Well, you know, it's pretty interesting. So in this report, we pull apart the differences across the generations, and we see that older generation spending growth is still pretty solid, while younger generations, I'm thinking Gen Z and millennials, spending growth around about zero. Why is that? It's because they've got all these other pressures on them that don't show up on card spending. Student loans, housing costs, childcare costs. Those are all eating into their reasonably strong wage growth. And two pressure points we point out in the report are credit card utilization is rising somewhat for millennials. It's a little bit above 2019 levels. Good news is it has flattened off that rise over the last year or so. And buy now, pay later, as you're discussing, that is showing a trend rise. I mean, I would qualify that by saying only around 10% of millennials and Gen Z are making those payments in the latest month. So it's by no means a pervasive thing, but that is rising.
So if we continue to have that rise, if there are little pockets of weakness, David, how important is it that we get some resolution in the tariff discussion? How much of the consumer spending we're seeing of credit card utilization, of willingness to make big purchases really hinges on outcomes we're getting from Washington, D.C.?
Well, I mean, I think it does help, but I would qualify, and we discussed this a little bit in a report today, you know, the swings in economic uncertainty and consumer confidence often have a surprisingly weak connection with what consumers actually do in our data and also the broader macro data. I'm not saying it isn't important, it is important, but I think consumers, all the time there's jobs growth, all the time there's wage gains, they will keep spending. So I think, you know, the weakness, if it came from that tariff story, that trade story, would come via corporates, slowing jobs growth, and then on to the consumer.
Let's talk about it relative to incomes then, David, because you're touching on something important. Are income levels holding up? Do you see that in the data you're looking at?
Well, you know, it's quite interesting. So we had this good jobs growth last Friday, didn't we? And in our data, we were quite pleased. We were quite pleased to see when our data stacks up, you know, closely with other reads. And in our data, we actually did see after-tax wages and salaries rising, the growth of that rising across all income cohorts. Now, it's strongest for the younger generations, as I was discussing earlier, and weaker for the older generations. And when you look at it by income, it's been softer over the last, say, 6 months for lower income households, but the pickup was across the board. So, and I think when you see that against what we saw, I think, on JOLTS, on the payrolls, it doesn't seem a situation in which the labour market is by any means weak enough for the consumer to really rein their spending in at the moment.
David, just to jump on this and just take you away from the latest report, as an economist, when you start to think about second round of effects coming off the back of the tariff story, do you think that maybe there is some fertile ground left here for inflation to bubble up?
Well, that's a good question. I mean, consumer spending is not, in an underlying sense, notwithstanding that drop we saw in May, soft, we don't think. So in some sense, consumers still are giving the economy the room for some pass-through, I guess, from cost pressures into CPI. So I don't make these inflation forecasts, thankfully, but I do think, you know, we're not necessarily in a weak enough for a disinflation kind of environment to take hold. Still very much a stagflation story, I think.
Interesting. David, thank you, sir. Appreciate the update, as always. David Tinsley there of the Bank of America Institute. I think we've all been super frustrated with the image survey, and increasingly that looks like a political poll and not an economic survey at all. income levels will tell you a lot about whether people are willing to spend or not, and that's ultimately where David took that conversation.
Which, by the way, the New York Fed Consumer Sentiment Survey we got yesterday is another great reason to maybe, I don't know, completely ignore you, Mitch. Not only did we get a rebound in expectations for inflation, labor market statistics, labor market surveys were also really, really strong too. So maybe you can just say it's noisy, all the data is noisy, the way people feel, it's really volatile. Maybe that's a problem within itself. But it's a reason not to put too much importance on some of these.
I definitely want to see more of that, that's for sure. Equity futures at the moment, by the way, if you're just tuning in, just about unchanged on the S&P, with an update on stories elsewhere this morning. With your Bloomberg Brief, back with us, here's Yahara. Hey, Yahara.
Hi, John. Ukraine says Russia attacked it with drones and missiles early this morning in Kyiv. This comes after the two sides started a major prisoner exchange. The first groups of prisoners under the age of 25 were transferred. The planned swap of 1,200 people from each side is set to be the largest to date since the invasion of Ukraine. Meanwhile, Huawei founder Ren Zhengfei is not concerned about U.S. export restrictions on China. The prominent business figure telling the Chinese Communist Party's official newspaper he is confident China can make breakthroughs in AI and software, but notes Huawei is, quote, lagging one generation behind the U.S. And in sports, the Florida Panthers had a commanding win in Game 3 of the Stanley Cup Final, beating Edmonton 6-1 on home ice. Panthers center Sam Bennett scored his league-leading 14th goal of the playoffs. The Oilers took 21 penalties, totaling 85 minutes in the box. The win gives Florida a 2-1 lead in the series ahead of Game 4 on Thursday night. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next, a test for the Treasury market.
Treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself.
In just a moment, we'll catch up with Tony Rodriguez of Nuveen on the bond market and get you the latest, an update on the trade talks in London between the US and China.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Tuesday morning, good morning to you all. Equity futures at the moment just about positive by almost 0.1% on the S&P, likewise on the Nasdaq. Under surveillance this morning, a test for the Treasury market.
Treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And so yields will go lower as sort of growth slows down. And I think from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself.
So here's the latest this morning. $119 billion in Treasury notes up for auction this week as traders look to gauge appetite for US debt. Tony Rodriguez of Nuveen writing, long duration is attractive as a hedge for equities and broader risk assets. Tony joins us now for more. Tony, good morning.
Good morning, Jonathan.
Do you think that more comfortable correlation does return then? Are you seeing signs of that?
We are seeing signs of that. You've seen that in some of the little hiccups we've had in the equity market. And when you think about why that's taking place, is that we finally have a yield level that's reasonably attractive. And you also have markets that we would argue are fully valued. Whether you look at the equity market, whether you look at risk assets, it's hard to argue anything's super cheap. So right now, when you're looking at the economy slowing down, rates being high, an investor that's looking for income and a hedge, we think you'll see that rally in treasuries because we think that will really reduce any inflationary pressure that comes into the economy through wage pressures, and therefore rates can fall in a really negative outcome, which is not our base case.
Sure.
But in that tail risk, we think it will serve as a good hedge.
That's the risk aversion test for the Treasury. Let's talk about the supply test for the Treasury market this week. 450, close to that on 10s, close to 5% on 30s. Sufficient levels to bring in that demand when we get those auctions this week?
Yeah, we don't think they're cheap enough to bring in excess demand, so you're not going to get the strongest auction statistics you've ever seen, but we think we're at fair value. So we're not expecting to see a failed auction this time, and we haven't really seen that, right? So bid to cover ratios have been okay. The tails have been average. We're expecting a similar story, but everybody's on alert for that first auction that actually, shows a really negative, soft outcome.
It seems like we've been on alert for a while, Tony, and it has yet to happen. Where it has happened is abroad. You saw weak auctions in Japan, and that was enough to move around the U.S. Treasury market. How fragile and how exposed are we still to international results from auctions and just more generally higher bond yields across the ocean?
Yeah, they're very correlated markets. We've seen term premium rise across multiple global markets, right? We've seen yields rising, so very integrated. So we are sensitive to that. But the good news is that you've seen policymakers also respond to that. So the Bank of Japan responded to that, so their quantitative tightening, they might slow that down. We saw the U.S. Treasury Secretary say that they may consider adjusting some of their supply, expectations over the coming months. So policymakers are responding to the potential for soft demand and longer duration assets, and that's supportive.
Is that not a problem, though, that policymakers have to respond? Tony, this is usually the thing you see in emerging markets, that there's not enough demand for longer-term debt, so you get changes or you get inability to actually issue longer-term debt. Is the very actions within themselves, the fact that they have to do it, a problem?
Yeah, we don't think it's a problem, but we do think it's reflective of the fact that the fiscal pressures that we are seeing globally, but dominated really by the U.S. right now in terms of 6 to 7% deficits, those are going to be something that has to be reckoned with. It's just that unlike in emerging market countries where that debt balloon pops and you get an immediate crisis, the debt balloon in a country like the U.S. is more like Japan in the 90s, where the air comes out slowly. So the U.S. is not going to, in our minds, have some sort of immediate sharp crisis, but it will have this kind of slower weakening that takes place from elevated rates that are a weight on growth, that take away some of the supply and ability for companies to finance as attractively. And so that just places a dampener on growth broadly. So it's a slower kind of pain than necessarily a sharp disruption.
You said risk assets were fully valued. Does that include credit and high yield?
Yeah, we think it's fully valued in terms of reflecting what are strong fundamentals. So we're not expecting a lot of price performance from tightening spreads, right? We think the carry, the yield, is pretty attractive. You can kind of earn that 7.5% type of return, which is comparable to equities with a lot less risk. And it's reflective of solid balance sheets, good cash flow, right? Defaults that are going to rise, but not very much. Where we're a little hesitant, because spreads are only fair, is to go down to the deepest end of the pool. So CCC credit risk might do great if the economy really performs well, but that risk reward is not as attractive as sitting in double B credit, higher single B credit, where again, fair compensates you for good fundamentals and strong technical conditions.
You could fool yourself into thinking, though, that there's no concern with the junkiest of credit, just given the issuance we've seen. I think for May was the strongest amount of junk bond issuance since October. There's demand there, and there's also taking advantage of a lull. But is it a false sense of calm? Are we tricking ourselves into believing that it is calmness, especially for the more risky edges of the market, especially headed into July where tariff deadlines come due?
Yeah, well, you bring up a good point. So a lot of companies, typically, they fail because of lack of liquidity than necessarily business fundamentals they can't work through. So that liquidity is very important. The high yield market had been kind of having below normal supply, and now that's kind of accelerated a bit, but it hasn't gone to an excess level in our minds. It's just gotten back to a normal supply-demand relationship. We think that's healthy. We think that liquidity is going to remain in place. So that's part of why we think the default story, while we'll see an increase, it's not going to be a sharp rise unless you get a really negative kind of exogenous shock, which could come from tariffs, could come from geopolitical. Absent that, the underlying fundamentals for cash flow and the liquidity conditions are pretty supportive of kind of remaining at these fair value levels.
Tony, I've known you for a long time. Just listening to you here, it feels as if April never happened. And looking at where markets are priced at the moment, it looks like April never happened. Has anything changed for you, fundamentally?
Yeah, well, yes. What has happened is that the kind of fragility that exists is greater today. So we thought we'd be growing at 2% coming into this year without the April news. Then you could kind of absorb a punch, whether it was oil prices, geopolitical. Now we're thinking 1% growth. So that at 1%, any shock, a disruption to a auction, for example, that can now push you into recession. So that tail risk has increased for us. So recession risk, 20% coming into the year, 35% now, still not base case, but enough to say what gets tipped over into default in that environment, it's those CCC weaker credits. So if they survive, we avoid recession, they're going to do fine. But if we have that little hiccup, that's where you want to be a little bit better, higher in quality, a little higher in liquidity to give you room to be able to adjust to those weaker conditions.
Got it. Tony, appreciate it as always. Tony Rodriguez there of Nuveen on fixed income. Could be interesting this week. CPI, PPI, 10-year debt auction, 30-year auction as well. Up next, we'll catch up with Mike Wilson of Morgan Stanley, Ben Callow of Baird, Matt Lazzetti of Deutsche Bank, and Terry Wiseman of Macquarie. Mike Wilson has 3 words for you. Don't fight it. That conversation up next.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, When they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Right now, we're witnessing a fundamental repricing.
The market has got, to some extent, I would say, desensitized to the daily gyrations in the numbers.
The markets have been very tolerant to a lack of concrete tariff progress.
Tariffs at this point in time, I think, are just overstated. The fear is more important than the fact.
Ultimately, we will break to new highs.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. And so far, pretty quiet. Equity futures positive by about 0.1% on the S&P 500, following back-to-back gains. It's day 2 of trade talks between the US and China. We'll catch up with Anne-Marie in just a moment. Anne-Marie reporting just moments ago. They're on a lunch break until 2 p.m. London time, so for the next 60 minutes or so.
They're on a lunch break, which is good news because we don't want to see anyone walking out for maybe any other reason besides food. You do get the sense, and John, I feel like we're hearing this more and more from people who are around this table, that the trade talks aren't the most important thing, is that it's earnings. There seems to be headline fatigue, real headline fatigue, of trying to trade on each individual thing that comes out of this time around London, and maybe you just need to focus on the company fundamentals, and earnings season wasn't that bad.
The earnings have been okay. The data's been decent too. Held up. I'll put it that way. If payrolls was bad on Friday, and some people think it was bad beneath the surface, I think we'd be having a very different conversation this week, and we mentioned that yesterday.
Yeah, Neil Dutta been very clear that underneath the surface that the labor market has not been holding up, that things like cyclical industries are starting to suffer. But even if the market data was bad, John, I wonder how much that would just cause a temporary blip, because there is this belief that you can't trust the data either, that you're seeing pull-forward effects, that sentiment is biased by politics and is uneven. There seems to be this real sense that you're not going to get any sort of clarity until much later this year.
More data this week, never mind this year. CPI, PPI coming up Wednesday, Thursday, and we've talked extensively about the data issues still to come too. The trade talks continue in London. We'll catch up with Anne-Marie in just a moment. Through this hour, we'll be catching up with Mike Wilson of Morgan Stanley as stocks look for a third day of gains. Ben Callow of Baird on his downgrade of Tesla to kick off the trading week. And Matt Lazzetti of Deutsche Bank looking ahead to that US CPI print. We begin this hour with our top story. Trade officials from the US and China meeting in London for a second day of talks. Anne-Marie joins us now with the latest. Anne-Marie, what's the latest?
Well, Jonathan, there's no breakthrough, but we do know there is a break for lunch. We did see the Chinese vice premier, who's leading the Chinese delegation, He Lifeng, leave Lancaster House. There is a break for lunch, and they'll be commencing again at 2 p.m. local. But you can see the talks really feel like they're coming down to a wire. Not only did the talks last more than 6 hours yesterday, but then they had to bleed into a second day. And we do know that Treasury Secretary Scott Bessent has to get back to Washington, D.C. He is set to appear on Capitol Hill tomorrow in front of the House Ways and Means Committee, and then the following day in front of the Senate. So he has these two hearings that he needs to get back for. So it does feel like the talks are coming down to the wire. What we do know potentially that we could see from these talks is basically what we saw in Geneva. Potentially the United States are going to get quicker, more accelerated licensing of rare earths and magnets, and for the Chinese side, potentially the most recent export controls that we saw since the Geneva talks could be lifted.
Reluctant to make too much of it. Don't want to introduce any drama where maybe it's not required. But Anne-Marie, we should talk about this. These things take time to discuss. But ultimately, the White House themselves made this all sound very straightforward. Listening to the National Economic Council Director, Kevin Hassett, just yesterday, he said this could get wrapped up pretty quickly. So there's a range of different outcomes here. Either what they thought was easy is turning out to be harder, or they're shooting for something much bigger.
That's right. And at the moment, we actually don't know. There hasn't been a ton of dialogue with the individuals that are actually inside the room. Yesterday, when Secretary Bessent did leave Lancaster House, he gave a thumbs up and said it was a good meeting. Howard Lutnick, the Commerce Secretary, who's an addition from the Geneva talks, an addition official at these talks, which makes you think export controls are really on the table and important for the Chinese delegation to have that discussion. He said they were fruitful. And then on the way in, live on Bloomberg TV, he said to us that they talked all day yesterday, they're going to talk again today, and they're spending a lot of time together. Just because they're spending a lot of time together doesn't mean we're going to get to the end negotiation. Potentially, China is viewing this moment as leverage, maybe, knowing that the Treasury Secretary has to get back to Washington, D.C. The president told Tyler Kendall yesterday in the White House that China can be very difficult to deal with. Really, what comes to mind for me is, what is the U.S. red line? If they're willing to lift the most recent export controls, we're talking about software for some chips, some nuclear and chemical materials, jet engine parts. But what China really wants to get their hands on is being able to get advanced semiconductors, those NVIDIA H20 chips. Is that potentially the red line that they are negotiating right now? Remains to be seen, but what we do know is that talks will continue at 2 p.m., and they just had a short break for lunch. But the Treasury Secretary, for him, the clock is ticking. He's on a stopwatch.
Anne-Marie, stay close. We'll catch up with you later in the hour with those talks set to reconvene, commence again in about 55 minutes' time. Here's the view on Wall Street at the moment. Mike Wilson of Morgan Stanley taking a very constructive view on things, writing, the rate of change has turned for the better on most fronts. This keeps us positive on U.S. equities on a 12-month basis. We expect pullbacks to be shallow and unsatisfying to those looking for a fatter pitch. Mike joins us now for more. Mike, good morning.
Good morning, John.
I love the recent note, don't fight it. So let's talk about don't fight what? What elements of the market move shouldn't we fight?
Well, it's kind of what we're just talking about. I mean, the headlines remain very noisy and uncertain, and I think, this has been the case for the whole year. Our view, as you know, has been a bit different. We came in thinking the first half would be tougher, and the rate of change on a lot of things like earnings revisions and some of the headline would be negative. And in fact, that what we think happens, that all got priced in the week after Liberation Day, right? It was violent. It was a deleveraging. And so now, as we look at the data itself, it's all inflected higher. And so, don't ignore everything, but ignoring the headlines is probably a good strategy, and just focus on the data has turned up for the most part. And I think, I don't know where the trade negotiations are going. Nobody does.
Sure.
But I think it's very unlikely we're going to go back to where we were, a month and a half ago. Like, we bottomed in terms of the pain of that initial, announcement and how bad those tariffs were. So unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
You know what the bear view sounds like? They would say that maybe some of the data, some of the earnings we've seen have been flattered by pull forward, and we'll get the bill for that later this summer. Do you think we're priced for that kind of slowdown, that weakness we could see in the summer months?
That's probably right, and we had that view too. There was a pull forward in Q1. Q1 ended up being better than they feared because, the numbers came down a bunch. I think the second quarter, though, is expected now to be weaker. So that's going to be the key. I think the biggest risk for the market is going to probably be either rates, as we've talked about in the past, north of 4.5%, or we do go into earnings season. It's not as good as, people were hoping for, and we have maybe a 5 to 7% correction. But that's not what people kind of want. People want another 10 to 15% drawdown to get, to get more exposure. And I just don't think you're going to get that. I mean, I've seen this a million times. You want it, but you're just going to have a shorter trigger finger.
Well, you had seen retail largely buying the dip. That's who participated when you got those ruptures in April. If we're not going to get dips like that anymore, what is the willingness of institutions to continue to put money to work right now, especially they didn't even buy the past dips we saw?
Yeah, I think institutions have re-risked, but there's still more to go. The area that I think that you have to watch is the systematic strategies, the CTAs, that price momentum money. We saw almost $500 billion of deleveraging in that period of sort of early March through mid-April, and they've re-risked maybe 30, 40% of that. So that's another bid that's sort of, it's not fundamentally driven. It's just price momentum. So that's going to be kind of the underlying bid. And then I think, most institutions have re-risked. But one thing I haven't talked about yet is people are still making the quality bet, and we agree with that. Meaning, this isn't the beginning of a new cycle. It's once again an extension of the existing cycle, and the Fed's probably going to be cutting at some point later this year, early next year, and that really behooves the large cap quality equities.
Does it behoove companies specifically who can also wait out some of the tariff uncertainty? Because this has been a big part of the narrative, right? No one's making decisions. CapEx is largely stalled unless you're tech. Is there an element where, even though we don't have tariffs resolved, that you get companies who just get on with it and start to put capital to work?
Yeah, they got to run a business, and that's another reason why large cap quality businesses can do this. They can mitigate some of these risks, whether it's tariffs, whether it's maybe the government cutting back on certain types of spending. And one of the things that is getting through this tax bill that I think is still underappreciated is the tax incentives for CapEx and R&D spending. We think that could add 3 to 5% to earnings growth or cash earnings for these large multinationals. That's a big tailwind in addition to the weaker dollar. So there's just a lot of tailwinds I see from an earnings standpoint, and this is almost a perfect environment to climb the wall of worry because the economic data, the political, geopolitical data is messy, it's noisy, it's scary sometimes, but as long as the revision factors for earnings are heading north, it's just hard for stocks to go down.
When you say CapEx, I just think of a handful of tech companies. Do you think it goes beyond just tech leadership?
Oh, absolutely. I think this is about capital goods. I think this is not just about AI CapEx. Also, one thing to just keep in mind, the IT CapEx that's been good the last several years has really been concentrated just in AI. Okay, the traditional kind of upgrades you see in the enterprise and in the household have not been happening because there was a giant pull forward, remember, in 2020 and 2021 for work from home. So if you actually look at the IT CapEx cycle from 22 to 24, it was kind of a soft recession. And that's another part of our thesis. We've been going through these rolling recessions. And look, to me, the big catalyst to keep in mind for broadening out is going to be when the Fed starts to signal they're more dovish. I don't know when that's going to be, but my guess is sometime in the third quarter they're going to start to signal that. And that's when you're going to get a more broadening out to the lower quality parts of the market.
Does the why matter? Do we need it because inflation is coming in? Or is it going to be because the labor market is cracking?
Well, I mean, look, last fall, it was both, right? I mean, the labor market was cracking last summer. As soon as they signaled they were ready to step in, the market went up anyway. So that's why, I mean, I actually think a recession, if we finally get the, broad recession labor cycle, I don't think the equity markets are going anywhere near the April lows because the Fed will be able to act quickly. And we're like Pavlovian, right? And if retail is buying when the Fed wasn't even cutting, if they are cutting, there's going to be a big bid there. So look, there's always risks in the market. There's always something to be worried about. There's always things to be bearish on, and there's things to be bullish on. And that's our job. And I think, this year we've navigated that pretty well, being in the right places. And I think we're going to continue to have to shift what we want to own, not so much how much you want to own.
You've acknowledged the one thing that could be a headwind for equities is interest rates. You wrote about it over the weekend. What is it about 450 that's challenging to this equity market? Because based on the rally we've seen over the past few weeks, we don't see much of a challenge.
Well, it's stabilized at 450. So we've identified this level like almost 2 years ago, and it's been like a charm. I mean, as soon as you cross 450 on the upside, the correlation between stocks and rates goes negative, and vice versa. Now, I do think that we kind of went to 470 in the April period, and then they calmed down again. I think the market is getting comfortable that they have enough tools, because the Treasury Secretary has talked about that, to keep it 450 or below if they need to. And I think we talked about this last time I was here. 475 is like the worst place, because that's where markets get really nervous. 5%, I actually get bullish, because then I know that they're going to come in and intervene with either liquidity injections or they're going to use these other tools that the Treasury Secretary has talked about. So we're optimistic that that could be managed. And in other words, that risk could be a risk for 5 or 7%, but ultimately that risk will get managed too.
Do you get clients asking you now about the debt auctions? Asking the equity strategist about the debt auctions that take place in the week?
Well, I don't really ask the equity folks, but I mean, people do ask about it for sure. I mean, and once again, we have seen many auctions, soft auctions for the last 2 or 3 years. We've seen this occur, and then they get control of it again. I don't want to dismiss the risk from the back end of the market. That is still, to me, the risk. I mean, it's the risk not only for markets, it's a risk for the U.S. Like we have too much debt, and this is a focus. And if we don't, ultimately, if we don't, cut the budget over time, and maybe the market is now giving them a lead, like, okay, we'll give you 12 months, but if we don't get serious about, budget reconciliation and actually reducing the size of the budget over time, this is an issue that's going to stay with us.
Mike Wilson of Morgan Stanley, 3 words over the weekend: don't fight it. Don't fight this market. Mike, thank you, sir. Appreciate it. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the latest out of Los Angeles. The Trump administration has deployed 700 Marines there to respond to protests around immigration raids. Meanwhile, the state of California is suing to try to stop the deployments with the National Guard already there. President Trump backed comments from border czar Tom Homan that California Governor Gavin Newsom could be arrested if he interferes with the response. Meanwhile, Blackstone is planning to invest as much as $500 billion in Europe over the next decade. In an interview with Bloomberg, CEO Steve Schwarzman said he sees the region as, quote, a major opportunity. His comments are the latest sign of more investment firms turning to Europe. And this is an interesting one. China has invited American social media influencers to join a 10-day, all-expenses-paid trip to the country next month. This is part of Beijing's efforts to boost people-to-people exchanges and showcase the, quote, real China. They will enlist influencers with at least 300,000 followers to collaborate with Chinese content creators. That's your Bloomberg Brief. John?
Recruit them into the propaganda machine. Yahara, call it what it is. Up next on the program, the Morning Calls Plus, Ben Callow of Baird on his downgrade of Tesla ahead of its robo-taxi test later this week. That conversation's up next, live from New York. You're watching Bloomberg TV.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The open in about 1 hour and about 12 minutes away. Equities into that positive by 0.2% on the S&P, up by 0.2% on the Nasdaq 100. Those of you just joining us, welcome to the program. If you're tracking trade talks between the US and China taking place, day 2 over in London at Lancaster House. They've just taken a lunch break. That's going to reconvene again in about 40 minutes' time. So 2 p.m. local. Look out for that a little bit later. Let's get you some morning calls. First up, Redburn, double downgrading McDonald's to sell, saying weight loss drugs are suppressing consumer appetites. That stock is down in the pre-market by 1.2%. Your second call from Loop Capital, raising its price target on Disney to $130, citing a more stable environment as it gains full control of Hulu. Keeps putting up prices. Stock is down by 0.5%. That's me editorializing. You see how expensive Hulu is now?
I don't have it for that very reason, so yeah.
Getting more expensive. And finally, UBS reiterating its neutral rating on Apple, noting a lack of AI announcements at its Worldwide Developers Conference. That stock is down by about 0.1%. Let's stick with the Mag 7. Tesla set to unveil its long-awaited robo-taxi on Thursday. Ben Kello of Baird downgraded the stock to neutral rating. We believe Musk's comments regarding the robo-taxi ramp rate are a bit too optimistic. This excitement has been priced into shares. Ben joins us now for more. Ben, welcome to the program, sir. Appreciate the update from you off the back of this call. Ben, I want to say up front, you are constructive over the long term on this name. Just walk us through why the change now.
Yeah, I didn't want to make it about the spat or dispute between the president and Elon Musk. This was something that, we had contemplated for quite a while. I do think that, the valuation has got ahead of itself around robotaxi. It's a very big event for Tesla. It's been in the works for a long time. I do think that 2 things, it's going to be higher competition when you get out there, Waymo, others. I do think the rollout will take longer. I do think that at first it will require more people, so people in control centers, making sure that the cars don't get into accidents if there's something like that. And so the economics will not be as good as they could be over the long term. And so I think that, as we get through this, the hype dies down and it becomes reality, and rolling this out will be very difficult. Not to say that Tesla's not done very difficult things in the past. I think there are other risks, though. I mean, key person risk outside of the president and Musk's spat. I think that retaining talent is something that I worry about. We did see the head of the Optimus program leave recently. The best thing about Tesla is their employees, innovation there. I think they'll always be able to recruit very strong engineers. This makes it a little more difficult. And then just very near term, I do think that numbers are too high for deliveries. We're seeing, a lag in all auto sales. But, with Tesla and, the brand damage that has occurred in different regions, I think that that's a risk as well. And then we have tariff risk, and we can go on for other risks as well. And so we thought it was time to just go to the sidelines for now. We do remain constructive in the long term. Short, intermediate term, though, I think there's downside to the stock.
So, Ben, let's unpack some of this. So 3 buckets of risk. We've got lofty expectations, key man risk, and competition. Ben, can we just sit on competition for a beat? Where is the competition coming from? Who do you worry about?
Well, in China, I think is the most fierce competition on the electric vehicle side. In the United States, I think that the ride-hailing robo-taxi service is going to have competition from the likes of the incumbents of Uber and Lyft to Waymo to others. There are several other companies out there. Amazon has a company that is working on autonomy as well, and so I think that the economics will not be as lofty as some people think. Additionally, it is also a consumer product, and so when we worry about brand damage for vehicle sales, you have to wonder about any kind of brand damage when you start getting into a car without a driver. And then third, in Europe, I think you have a host of competition, and lots of bears over the years have talked about competition, and it hasn't really gone anywhere. But now you have the likes of BYD selling into Europe. Tesla sales were better in the last month than BYD, but BYD is catching up with them. And then you also have Germany that are making a big push for their domestic OEMs, auto manufacturers, giving some types of credits or breaks on their cars to try to catch up with Tesla as well. And so you kind of have it coming in all different directions right now.
On the driverless vehicle side of things, we also learned this morning that Uber would be partnering up with a company called Wave to try to launch robo-taxis in the UK. Ben, a really tried and true business model for tech had been prove it works in America and then export it abroad. When it comes to a robo-taxi for Tesla, is that option, is that business model for growth not as available to them because of the brand damage you've been talking about?
I think it is, and I think one thing about the key person risk and Elon, this double-edged sword. I remember during the Biden administration, Elon gets on a plane and goes and meets with Xi, and just out of the blue, and he had his reach stretches very far. I think that there are difficulties in China about data. They have made progress there. Europe is a little more, the EU is a little more bureaucratic, I think, and more difficult, like a patchwork, to get approval there. In the U.S., one of the fundamental things that the relationship between the Trump administration and Musk had going for it is to try to have a blanket federal rule about advancing autonomy versus the patchwork state way that we have it right now. So I think they'll be able to move outside of the United States in this. I think it takes time. One of the advantages they have is they're going for this all visual, all camera approach versus much higher cost for a Waymo. A Waymo vehicle costs over $200,000, and so it's much more capital intensive. There's still a big debate whether Tesla's approach will work in the long term, but that remains to be seen.
Ben, just before you go, I know you don't want to make the downgrade about the spat between Elon Musk and the president, but I'd love a comment from you on that. Do you think we made too much of a big deal of that about what it means for the stock? What was your general reaction to how that played out?
Well, I think it's bad for our country, and I love our country, and I think that being public in this dispute like that, and it got pretty racy. I don't think that's good for anyone. Tesla, SpaceX, Elon's other companies, some of the most, if not the most innovative companies in our country right now, and getting down and dirty in the sandbox doesn't do anyone any good.
It's hard to disagree with that, sir. Ben, appreciate your time this morning. Thank you. Ben Keller there of Baird. Tesla in the pre-market doing a little bit better, positive in early trading. Up next on the program, we'll catch up with Matt Lassetti of Deutsche Bank with key inflation data due out this week and why Matt Lassetti means maybe this economy has maybe adapted to interest rates of 4.5%. We'll get into that in just a moment. Live from New York, you're watching Bloomberg TV.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening bounce 60 minutes away. Equity futures on the S&P 500 positive by a little more than 0.1% on the S&P. Similar move on the Nasdaq, higher by close to 0.2%. With 1 hour until the cash open. With your morning movers, let's get back to Yahara. Hey, Yahara.
Hi, John. We start with J.M. Smucker. Those shares are falling 8%. The packaged food company just reported results and profit forecasts disappointed. This is because the company behind Folgers Coffee and Jif Peanut Butter said tariffs are hitting its coffee business and consumers are pulling back. Yet despite that consumer hesitance, it still plans on raising prices. We'll see how that works out for them. But one bright spot at the company that they did mention is that apparently Uncrustables are flying off the shelves. Not the same enthusiasm for McCrispy chicken strips at McDonald's, our next stock, which is down 1.3% after it was hit with another analyst downgrade this morning, this time by Redburn. Yesterday, it was Morgan Stanley. And then there was Loop Capital, which flagged that people were complaining about those McCrispy chicken strips, saying that not only were they smaller, they also had less bread. So they also cut their rating. And turning to something outside of food, because I'm getting hungry, we turn to Meta Platforms. Those shares are up 1%. And this is as we here at Bloomberg report that CEO Mark Zuckerberg is apparently frustrated with their chatbot models. And this is because of this, he is personally building a secret super intelligence team, even holding recruiting events at his homes in Palo Alto and Tahoe as he tries to assemble the best of the best to try and achieve artificial general intelligence. John?
Yahara, thank you. Thank you very much. Three of the movers to look at going into the opening bell about 60 minutes away. Later on this afternoon, we start working our way through some debt supply. 3-year notes, $58 billion worth. On to tomorrow, 10-year notes, $39 billion worth. After that, $22 billion of 30-year bonds. Of course, all of this taking on additional importance after the tax bill advanced through the House and onto the Senate and all the debt concerns over the past few months or so. That's the debt supply story. Also some economic data, a double dose of inflation data this week. CPI due tomorrow, PPI after that. Mike McKee has more for you. Good morning, Mike.
Good morning, John. I'm going to say something you haven't heard me say in a while, and that is that the CPI report tomorrow could actually be important to the markets. Not going to change what the Fed is going to do next week, but we may get our first clues as to some tariff pass-throughs to consumers as companies try to deal with the uncertainty and the tariffs that we have already seen. The consensus is we're going to see a rise on a year-over-year basis in both the headline and the core. It's the first increase since January. The survey, though, says the risk is to the downside. If there is a surprise, it may be a little bit less inflation than we anticipated. But we will be parsing all these categories for tariff effects. The pass-through is expected, at least according to Bloomberg Economics, in food at home. Yahira mentioned getting hungry. Grocery prices are down, according to the USDA, which does its own monthly survey. Furnishings, apparel, electronics, all those are imports that we could see higher prices feed through into and used in new cars because of the tariffs that the president has put on automobiles. On the other side, we have declining gasoline prices and natural gas prices, so energy could be lower. Core services could be lower as well. Airfares and lodging probably have fallen because travel has fallen off. So those are things to watch tomorrow. There's one other thing that all the Wall Street economic nerds are going to be watching, and that is the Trump pass-through to the survey itself. Because the Bureau of Labor Statistics had to let go people and people have quit, it did appear last month like the survey had a larger than expected response rate because perhaps they dropped some survey places from the list. And that would require them to impute more prices than actually getting the specific price levels. So there may be some questions about the data tomorrow. That's something to keep an eye on.
Mike McKee, thank you, sir. Could be the calm before the storm. Mike McKee, thank you so much. Matt Lozzetti at Deutsche Bank is with us around the table. Matt, good morning.
Good morning.
It's good to see you, sir. Let's talk about whether it's too early to see that kind of inflationary impact from the tariffs tomorrow or not. Is it?
So I think from a broad-based perspective, it likely is. I think if you look back to the previous CPI, you began to see it showing up in some of the data points. But that's been offset by some of the discretionary services items, whereas we've seen weakness, such as airfares. You saw it in the PPI data last month, and it typically takes a few months for that really to begin to show up into the CPI. And so our baseline expectation is you get a little bit more evidence of it in tomorrow's print, but really it takes the June, July, and then August data to get stronger evidence of tariff pass-through.
What would you need to see to say, you know what, I think this could be sustained, this could be sticky, it's not a one-off shock?
So I think it's going to be hard in this environment. I think typically if you go back to what we saw of the post-COVID environment, initially there was this view that it might be transitory or temporary. And that view was dominated by the fact that it was narrow on a few items, used cars, other core goods at that point in time. I think to think about it being stickier, you want to see it broadening out across the basket. So probably not just in core goods items that you can readily identify for tariff effects, but other items. So for example, as you get vehicle tariffs, you're likely to see car repair pick up with some lag. Car insurance inflation is going to pick up alongside of that. I think those are the effects that you'd want to see to get some sense that it's a little bit stickier than anticipated.
There was an expectation that in this 90-day pause with China that you'd see a lot of shipments come in, that people would front run it, make the data messy, et cetera. We haven't really seen that. There hasn't been a lot of action in the ports. Is this still an economy in suspended animation, and when does that change, if so?
I think for a lot of ways it is. Now a lot of this halting or stalling out is just give back for surge in imports that we had in Q1. And so particularly in the trade data, you've had this massive volatility where net exports were very weak in Q1, are going to be very strong in Q2, lifting the GDP data. But I think the market kind of understands that. I think we're now in an environment of where's the pass-through to the other components of especially what the Fed cares about. The labor market, are we seeing layoffs take place and hiring dip? So far, I think the answer is not yes. Last week's jobs report was mixed, but resilient enough, I think, for the market. And then secondarily, when we begin to see it in the inflation data. Again, I think we've seen it in the PPI data so far, still waiting to see it for the CPI. We're not surprised that you haven't seen it yet. Our baseline expectation, if you go back to 2018, 2019, is that it was always going to take until the June, July, and August data to see the effects.
I just want to flag some of the language you used. When you asked, has there been weakness in the labor market, you said not yes. You didn't say no. Are there pockets of weakness that you're looking at that you're concerned might bubble up into something more concerning?
I think you still have this labor market, which has been identified by a low hiring and firing environment. If you look at the JOLTS data last week, the hiring rate remains low, but layoffs remain extraordinarily low as well. That's always been a fragile equilibrium. Now, nothing has broken. That equilibrium has persisted. But there was worries, at least initially, that the tariff shock, the uncertainty that's come along with it, if financial conditions were tightening, that could lead to the layoffs that could kind of break that fragile equilibrium with the labor market weakening more materially. We didn't see that last week, but I think that's still a risk as you look ahead.
You mentioned something in a recent note about interest rates maybe stabilizing around 4 to 4.5%. Can we sit on that story just for a moment? Because I thought it was a fascinating note. Do you think we've fully adapted to an interest rate with something close to 4%? And what does that tell you about how much this Fed might cut if we see some weakness down the road?
Yeah, so I think the main chart of that piece was showing, if you look at where the Fed funds rate has been, we've been at 4.3% since December. If you look at headline PCE inflation, at least, it's at 2.1%, basically within spitting distance of the Fed's target. And you look at the unemployment rate, we've been stuck at 4.2% for several months at this point. That 4.2% is exactly in line with what the Fed thinks the long-run unemployment rate is. And so if you look at that chart, it looks like you've settled into what economists would call a steady state, for the economy. It actually looks like you've simulated the economy through a model where you're at kind of equilibrium and everything is working its way out. Now, we've been in the high R-star camp for a while. We pegged at the nominal neutral rate between 3.5 and 3 3/4. So we've always expected this cutting cycle to be shallower. But we're just proposing the possibility that there's not much evidence that we're very far away from neutral at the moment.
This conversation was kicked to the sidelines because of the tariff story over the last few months. I get all that. But is the Fed moving towards you? Do you see the Fed moving closer towards you in the coming meetings?
I think so, and we'll get maybe some evidence of that next week. We'll get the dot plot next week where I think there's broader expectations that the Fed will signal a more hawkish stance. We'll be looking at the long run dot. Does that continue to migrate higher? My guess is that it does. So they've been at 3% for the long run nominal neutral. That probably continues to move higher. I think the balance of estimates that we look at are kind of closer to 3.5%. But I think to really fully embrace the idea that neutral is materially higher, you have to get beyond the tariff concerns, the uncertainty shock that we've had, and have a labor market that still looks resilient 3 to 4 months ahead.
Since you took us to next Wednesday, let's sit on next Wednesday. How useful is the rest of the SEP from the Federal Reserve?
I think it's an environment where, Chair Powell likes to, I think, downplay the signal from the SEP when it's kind of convenient. This will be an environment where it's probably very convenient. I think the market will, if they only show one cut next week, which I think is broadly anticipated, the market will move to what do next year's forecasts show. Does inflation rise a little bit? Are they showing some stickiness there? Are they showing less cuts through next year? I think that could signal kind of a more hawkish stance, but I would also anticipate that Chair Powell kind of tries to walk that back in the press conference. I think they don't know, we don't have huge confidence about what policy is going to do this year because there's still tariff-related uncertainty, fiscal policy uncertainty, a view towards next year about policy is going to be.
He's not going to be there through much of 2026. Does that complicate signaling at the top of the Federal Reserve?
I think for now, they're kind of more focused on the near term. And so they're sending a strong signal that they're in a wait-and-see mode, that they're well-positioned to respond to risks. And I think that signal will continue. Certainly over the summer months, as perhaps you get some evidence of who President Trump may appoint to the board, I would expect that in replacement of Governor Kugler in January, that could be the next potential Fed chair. Certainly the market focus will shift to that.
Matt Lazzelli of Deutsche Bank. Matt, appreciate the time. Looking ahead to inflation tomorrow on Wednesday, then a week tomorrow, we get that Federal Reserve meeting, we get the statement, a news conference, and an update to the summary of economic projections as well. If you are just joining us, welcome to the program. Equity futures almost totally unchanged through most of this morning. A bias to the upside over the last month or so. Again this morning, up by something like 0.2%. With an update on stories elsewhere, let's get your Bloomberg brief with Yahara Arnott, who has more. Hey, Yahara.
Hi, John. Trade negotiations between the U.S. and China are continuing for a second day in London. The U.S. signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will ease limits on rare earth shipments. Treasury Secretary Scott Bessent said they had a good meeting yesterday, and Commerce Secretary Howard Lutnick called the talks fruitful. Meanwhile, here in the U.S., Health Secretary Robert F. Kennedy Jr. dismissed all 17 members of a key federal vaccine advisory panel, accusing them of conflicts of interest. Before joining the Trump administration, RFK Jr. was known as a vocal critic of the committee, which advises the director of the CDC and helps shape national public health guidelines. And Apple unveiled the most sweeping redesign in its history at its Worldwide Developers Conference. The design, called Liquid Glass, will unify user experiences across all devices from iPhones to MacBooks. As part of its rebranding efforts, the company also confirmed that it will use years, not version numbers, to identify its software. Less confusing. That's your Bloomberg brief. John?
Yahara, very much so. Yahara, appreciate the time as always. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Terry Wiseman of Macquarie with key Treasury auctions coming up. 10-year supply, 30-year debt too. Plus, the conversation continues in London, negotiations between the US and China. We'll touch base with Anne-Marie on the ground in Britain's capital in just a moment. From New York, you're watching Bloomberg TV.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television, top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The cash open, the opening bell about 44 minutes away. Equity futures into that just about positive by close to 0.2% on the S&P, and the Nasdaq a similar amount higher, up by 0.17%. Bit of a snooze in the equity market through most of this morning. In the bond market, things could get interesting tomorrow. 10-year debt, day after 30-year supply. This morning, yields coming in down by 2 basis points, 4.45, close to 5% still on 30s. Danny at 4.91. Tony Rodriguez of Nuveen on a program earlier. Nothing to see here, nothing to worry about.
I think there's a sense that, hey, that's a pretty attractive yield. Yes, there's some volatility there, but perhaps we look back at this period and say around 5%, that was the buy of a lifetime. So you have an auction coming up. Maybe that's enough not to entice really outsized demand, but enough demand that we don't get worried about it.
More on treasuries in just a moment. Still close to 450 on a 10-year maturity. Looking ahead to those debt auctions. Also looking ahead to this as we count you down to the opening bell. Your trading diary is shaping up as follows. Today, the US and China holding trade talks in London. Day 2, that continues. Tomorrow, CPI data plus. Treasury Secretary Scott Bessent testifying on Capitol Hill. He's in London right now. On Thursday, PPI and another round of jobless claims. And Tesla's robo-taxi launch over in Texas. And then going into the weekend, another read on that political survey. The political poll that is now the image sentiment, consumer sentiment survey. Day 2 of trade talks very much underway between the US and China earlier on this morning. Anne-Marie joins us now from London with more. They broke up for a lunch break, Anne-Marie, just moments ago in the last hour or so. What's left to negotiate for the day ahead?
Well, it's a great question, Jonathan. There really is no update here because after more than 6 hours of talks yesterday, 2 hours this morning, they did break for lunch. They should be reconvening around 2 o'clock local, so just in the next 15 to 20 minutes or so. We still don't have an agreement in place. And the last we heard from the president was that China is difficult to deal with, and he kept it pretty open-ended on how much he was willing to lift and ease some of those export controls, especially when it comes to advanced semiconductors. So we're still waiting to hear on what the update is. We should remind our audience that whatever we get out of this was really about reigniting confidence between this relationship. After just about 10 days ago, the Treasury Secretary felt that talks stalled between China and Washington, and this had to do with what they agreed upon in Geneva. The United States wants to see a more accelerated pace when it comes to the licensing of rare earths and magnets, and what China wants is the easing of those export controls. But really, how much is the U.S. willing to give in? Will it be the most recent export controls, or are things like the H-20 chip on the table? Kevin Hassett says they're not. But let's see what they come out with today. Talks still ongoing at the moment.
Anne-Marie, a theme for us so far this morning, just a reminder of the bigger picture. How long it took to secure a phase 1 deal in the president's first term. I remember things getting hairy in July of 2018. It took 18 months to sign that phase one deal in January 2020, and then we got into the pandemic, and then that phase one deal was quickly forgotten about. How different are things going to be this time around?
Well, trade talks, trade deals take a lot longer. They take years, not days. We're in the first inning of this relationship in Trump 2.0. To your point, Jonathan, Trump's first administration, and we were talking about a purchasing agreement that started in 2018 and it ended in 2020. That was a purchasing agreement. When you look at the contours of what they are discussing at the table for this agreement, there is a whole host of issues and potentially different tools in the toolbox that the United States and the Chinese are going to use. At the table today, we're just talking about really rare earths and export controls. And now you have national security taking center stage. So actually, Trump 2.0, the negotiation seems even more complicated than during his first administration.
MH, Anne-Marie, we're still hopeful we get you back in the studio tomorrow morning. I know the flight is booked later on this evening. Let's see if this wraps up in time.
Me too.
Anne-Marie from London, thank you. We're also keeping one eye, a few eyes, both eyes on Treasury auctions tomorrow. 10-year notes, 30-year notes, all coming up over the next couple of days. Terry Weissman of Macquarie joins us now for more. Terry, good morning to you.
Good morning, John.
Should we worry about 10-year and 30-year supply?
We should worry a little bit more about the 30-year auction. I think the pattern in the last few months, based on what we've been seeing out of the indirect bids and purchases, has been that foreigners are stepping away a bit from the long end of the curve. We've actually had strain from indirect bids at the shorter end of the curve. What that tells me is that foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they lost some confidence in the ability of the U.S. to manage its deficit. I think these are all part and parcel of the narrative around why the 30-year yield has gone up as much as it has in recently.
The price surely matters. Does 5% help? Does 4.90 help on a 30-year?
So what I tell clients is that if you look at bond yields, there's really two approaches here. There's a cyclical approach, and based on the cyclical approach, on the presumption that global growth is slowing, on the presumption that U.S. growth is slowing over the next few months, in part because of the tariff shock, you should expect yields to come down. From that perspective, even the 4.50 we're seeing on the 10-year has room to come down, maybe down to 4.25%. But I think from a longer-term perspective, 5% may not be enough, or 4.5 on the 10-year may not be enough. We may have to see higher yields to equilibrate demand and supply in view of a lot of things, a lot of narratives, a lot of trends out there that are inflationary and tend to move people away from a willingness to buy nominal assets like U.S. Treasuries. What are those tendencies and trends? It's deglobalization, it's demographics, among two important ones that are going to tend to produce some inflationary pressure, not just for the U.S., but for the world over the next few years. And from that perspective, it's I'm not saying that the 30-year should go to 7, but I think we're only seeing the leading edge of the nervousness that's coming with the realization that we may be stuck in a higher inflationary regime going forward.
So if it's not 5 and it's not 7, where is the level that makes sense in this environment that you would be more willing to dive in?
So a lot of this depends on whether or not people's perception of the deficit in the U.S. is going to remain adverse and pessimistic or optimistic. It's a little too early to say, in part because we don't know whether or not the Senate's going to push back on the House's bill. But let's say the Senate does not push back on the House's bill and there is more nervousness about long-term supply. I can certainly see the 30-year moving higher in yield.
Torsten Slok yesterday argued that it's an issue that you have half of the fixed income being issued from the government, that it crowds out other investment for both consumers and corporates. Is that a real problem when you have so much of the issuance skewed towards government debt instead of corporate debt?
In a country like the United States, where savings rates are relatively low compared to other countries, and it's difficult to motivate more savings out of consumers and businesses, I would say yes. The more issuance there is, the more likely there is going to be pressure on upward yields. And yes, to some extent, this will crowd out private investment. That doesn't mean that what the government does with its money has a lower rate of return, and therefore we should promote necessarily private investment at the expense of whatever the government is doing with its money. But yes, to the extent that yields are higher, there is crowding out. It's more or less standard economic theory at this point and accepted by the markets that more issuance you have, the higher yields will be. And of course, it's not just the supply issue. There is the risk premium as well, right? We've seen CDS, sovereign CDS spreads in the U.S. moved to 58 or 55 basis points. It's now rivaling Greece. I think to some extent that reflects nervousness about the fiscal outlook. And yes, that's an aspect beyond supply, of course, of the U.S.'s fiscal outlook.
You're in a great seat because you don't just cover interest rates, you cover foreign exchange as well. I'd love your view on the FX part of this. You talked about foreign investors maybe leaving behind the long end of the curve and shortening up duration and coming into the front end. Some of them just worrying about foreign exchange and pulling out of dollar-denominated assets wholesale and retreating to domestic markets. Now, price action shapes narrative, it also reinforces behavior. How much of that just becomes self-fulfilling, that people start to see this dollar weakness and it just accelerates those moves in months to come? Things seem to have settled down now, but do you expect to see bouts of this in the year to come?
But that's a technical argument. It's a technical for the dollar. In fact, I would say it's adverse for the dollar because we're coming off a 12-year period of dollar appreciation in real terms. I keep repeating this to everyone I see. If you look back to 2012 and you compare it to end of 2024, we've had a 40% real appreciation in the value of the dollar. So we're starting from a situation where the dollar is rich. We're also starting from a situation where people all of a sudden are very much concerned about policy uncertainty emanating from the U.S. And I think that's going to be an important driver of perceptions around the dollar. The dollar's brand value has certainly faded over the last few months, in part because of the uncertainty, the abruptness, the aggressiveness, the pugnacity of policies coming out of Washington. So I think we're on a long-term downward trend for the dollar. It doesn't mean to say, of course, that there aren't a certain class of investors that are inclined to buy on the dip. I would not necessarily be one of them. I'd keep my eyes on the next 2 to 3 years.
Terry, appreciate your time.
My pleasure, John.
As always, thank you, sir. Terry Wiseman there from Macquarie. Looking ahead, some key economic data points, and I'm not talking about CPI and PPI. We're talking about 10-year auctions and 30-year debt supply. Coming up tomorrow, we'll catch up with Torsten Slock of Apollo, Bob Diamond of Atlas Merchant Capital. We'll speak to Seth Carpenter of Morgan Stanley, David Kelly of JP Morgan Asset Management, and Danny's off to California, right?
I am. Off to LA to cover the Bloomberg Credit Forum with Lisa. So we'll be hand in hand. Sorry to leave you alone around the desk, John.
Looking forward to the coverage. Hopefully, I said it earlier, hopefully Anne-Marie makes it back in time for the program tomorrow morning. She'll be covering the talks in London between the US and China. From New York, thank you very much for choosing Bloomberg TV. It's a quiet start to the week. It gets busier tomorrow morning as we look ahead to CPI data. From New York City, this was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the AI race. Meta assembles a super intelligence team while Apple expands its deal with ChatGPT. U.S.-China trade talks continue in London for a second day as the two sides look to ease tensions over key tech and industrial goods and a bargaining chip. We'll explore how Boeing has emerged as President Trump's preferred trade tool to gain leverage in negotiations. What are the stocks that we're watching right now?
Let's go back to Meta because this is an interesting one. Meta recruiting dozens of experts to achieve artificial general intelligence, which can theoretically perform tasks as well as humans. This is a clear priority for Mark Zuckerberg, who is personally hiring the team and also arranging the desks to sit near him. Perhaps that's why you've Meta shares higher by about 1.2% right now.
Yeah, in terms of Apple, at the Worldwide Developers Conference, it's super boring, not impressing analysts on the street despite an advanced partnership with OpenAI, a refresh of their operating system. Can't they do better than that right now? Investors don't think so, and the shares are unchanged, Katie.
Well, keeping the conversation going on AI, ARK Capital's Cathie Wood spoke with Bloomberg about the promise of AI at the Greenwich Economic Forum last night.
Generally, we think the cost of innovation is collapsing here. AI training costs are dropping 75% per year. AI inference costs are dropping 85 to 95% per year. And generally, AI is, we think, going to level the playing field.
For more on all things AI and tech, we're joined by Bloomberg Tech co-host Caroline Hyde and Mandeep Singh, global head of tech research for Bloomberg Intelligence. Caroline, let me start with you and just ask you why Apple can't do better. I mean, they've come up with very little, and investors really aren't impressed.
Yeah, I mean, some analysts going as far to saying it was a dud. There seems to be a much calmer, more soothing way of delivering us updates, but none of the flashbang wallop that we're used to. And this is indeed trying to make iterations, trying to say, look, all your products are going to work better together. It's going to have a new look, a new feel. Liquid glass is going to be more beautiful aesthetically. And indeed, you do get more fun. I don't know about you, I'm vaguely interested in my emojis becoming, two emojis becoming one and a Genmoji experience, but that is not the AI that we want. Yes, translation is going to be super useful. Yes, we're going to be able to perhaps have more an adept experience, but where is the Siri upgrade? That is what seems to be being delayed. We got hints that, look, it's not going to be until at least next year. And meanwhile, others are leading the pack when it comes to Alphabet, what they've integrated into their Android more broadly. So I think that there are, around the edges, some sophisticated changes. Yes, you've got the gaming platform coming into being as well, but this wasn't enough to drive any sort of stock reaction, and a lot of analysts are disappointed.
Right, you look at Apple shares yesterday, they actually fell by 1.2%. So investors clearly not excited about these non-AI upgrades, Mandeep. As an analyst, was there anything that caught your eye, or is it really about what they didn't say?
Yeah, I mean, from my perspective, Apple is positioning themselves slightly differently than Google or Microsoft because their big bet is on on-device AI. Now, I agree with Caroline, you know, there wasn't anything about Siri. So if you're talking on-device AI, that's a #1 surface area where they should be showing, you know, a lot of use cases. But that being said, they launched this foundational model framework, which is essentially saying anybody who has a large language model can work at the operating system level. Obviously, Apple will oversee the deployment of that LLM, And these models on device will be a lot smaller than your large language models that are working on the cloud. So look at it this way. Apple already has all the apps that give you AI functionality through their app store. They're trying to position themselves on the on-device side because no one else has a surface area when it comes to on-device AI. Apple still controls all the devices in their ecosystem, and they want to play it at that foundational layer, which is what they are focusing on.
Look, it's becoming, technology is becoming such that I go to ChatGPT for pretty much everything. Yeah. And in order to do that with Apple, especially if I'm driving, I have to figure out a way to open up the phone, get into ChatGPT, switch it into voice mode. I mean, couldn't they have done that? Can't they just hire the 50 smartest people in the world and make it happen instantaneously?
Well, so that's where the size of the model does make a difference. You're absolutely right. You know, they can hire the engineers, but the way these models are evolving, they're pretty big in terms of, you know, the size of the model, the number of parameters. So you really have to solve for not only the large language model, but you also have to distill it down to the level where it can run on device because they're using it on your sensitive private data. They don't want it to be mixed with all the other data that's sitting inside a large language model. So that's where the sensitivity for a user data running on device, it's a lot higher than an LLM answering, you know, general search queries, which is what ChatGPT is doing right now.
Right. Well, they can't hire the 50 smartest people because that's what Meta is doing when it comes to super intelligence, this ambitious team that it seems like Mark Zuckerberg has a real personal hand on.
Where's Tim Cook's invites to these various array of AI innovators to Lake Tahoe, to Palo Alto, to go and dine with him, because that is what Mark Zuckerberg is doing. He has gone founder mode, as we know. This is all about really getting to grips. He's stripping back delegation. He wants to be hands-on when it comes to generative AI because he's been disappointed. Look, Llama 4 didn't live up to the expectations of just how sophisticated the new integration of generative AI was, and indeed how much better it performed compared to the previous open source models, technically open source, some would say, perhaps not, that they've been developing. So he wants to get Behemoth out there. To do that, he gets the 50 smartest people, whether you're an AI research head that he needs to hire. What's so interesting, and I'm sure Mandeep's got plenty of opinions, on the Scale AI news coming out just recently, the $10 billion investment they're going to make in that company, the fact that Alexander Wang is going to be becoming part of that team, that you said, Katie, is going to be sat really close to Mark Zuckerberg in the Menlo Park office. I mean,
assuming they come to the office every day, which if they're the 50 smartest people in the world getting paid so much they can't believe it, I don't believe they're going to all show up to work every day from 9 to 5.
But they get the chance to sit next to Mark Zuckerberg.
Yeah, but look, having 50 cooks in the kitchen, is that really going to help, Mandeep? Is that the way to solve this problem?
I think in this case, you need, you know, smart as brains. Not one person can figure out everything related to AI.
Will they all work together seamlessly? I mean...
Well, Mark Zuckerberg has a playbook. Remember when TikTok really took off? That's what he did. He assembled a team that really created the Reels product and made sure that it caught up with TikTok. So I'm not surprised he's going back to that familiar playbook where he's personally involved in everything that's going on at the product level.
Katie, is Reels as good as TikTok?
No, no. I have to say the content on TikTok, you'll see it on Reels 2 weeks later, to be a bit brutal there. But I mean, you know, it's catching up, and a lot of people, sort of the old people, use Reels.
So that's the way Mark Zuckerberg can become second best, is what you're saying.
Maybe have a WhatsApp party. What's it called? A recruiting party. Formed this whole WhatsApp group among all of his key leadership that he wanted involved. They're getting messages on this noon, day, and night.
I'm sure they are. I want to go back to what you were saying about Scale AI, though. When you wrap together this news about the super intelligence group, it seems like that's related to perhaps the Scale AI investment. And then you think about what we were talking about last week, that Constellation, that investment that they're doing in Constellation as well. It seems like Meta just is moving super aggressively here. And it's interesting to contrast that with what we're getting from Apple this week.
And also the fact that they're going into usually areas that they'd stuck away from. Remember, they've got to deal with Anduril. They're going to be offering their technology for defense as well. Alexander Wang's already been helping advise the government. There's a more federal integration here that, of course, we know Mark Zuckerberg is making moves on in his relationship with overall the administration. So I think that we are seeing all in on all things generative AI from Meta, and indeed becoming almost a data center owner. I mean, they become a technical hyperscaler. Yeah, they're not going to be offering you cloud, and that's what's interesting with scale AI investment. Is this just going to be $10 billion in money, in investment, or is there any offering of data GPUs? Because that's certainly what we saw a bit more with the Amazon and Alphabet tie-ups with Anthropic that we've seen. And of course, Microsoft has led the way with its integration with OpenAI and its relationship. This is Meta getting in on that act and wanting the data superiority that we get with Alexander Wang's Scale AI, and more broadly, how they're thinking about using and building models for that company too.
Yeah, it's certainly a statement of intent by Meta. It's going to be fascinating to see how that plays out. Great roundtable, you guys. That is Caroline Hyde of Bloomberg Tech. You can catch her at 11 a.m. and Mandeep Singh of Bloomberg Intelligence.
We should point out that Meta is crushing it year to date. I've just put them up on a screen against Apple, Microsoft, Amazon, Google, and Meta is doing the best of the group. So you can see the gain. The year to date is only 19%, I guess. But
only
of course,
19%?
Well, they've come back so much from the lows that we saw in the middle of April.
Yeah, and you consider that in a relatively flat market, 19%. A lot of companies would certainly take that. Let's take a look under the hood, though. We do have some movers on our radar. Novo Nordisk, for example, jumping after a report that activist hedge fund Parvis Asset Management has built a stake. This is really interesting because remember, Novo replaced their CEO just in the last couple weeks. That was certainly a surprise move. And
Don't
now
miss a chance to say his name.
Lars Frogard Jorgensen.
Love it.
Yeah, there we go. Now we have news of an activist in that company. We'll continue to follow that. But JM Smuckers.
These are your people.
These are my people. These are all the stocks I'm interested in. Smuckers profit going to take a hit as sales are weighed down from its Hostess brands. People are buying fewer Twinkies. They are still seeing growth, though, in Uncrustables, Matt. I'm sure you're familiar with that product.
I actually bought a box of Uncrustables to find out what all the hype was about, and I haven't found a time to eat them yet.
Anytime.
It just seems incredibly unhealthy.
No,
to pull out pre-made peanut butter and jelly sandwiches from the freezer and then lunch them down.
It's super efficient. You just take them out. You have to let them defrost first. Don't eat them before they defrost.
McDonald's downgraded by Redburn. It says weight loss drugs are an underappreciated long-term threat, which is like, who was underappreciating that? We've been talking about it for like 2 years.
I was thinking this is very much a sell-side call from 2023 or something like that. But McDonald's shares down about 1.5%. You know what else is happening today?
Yes, I do.
It's day 2 of trade negotiations in London. We're live from the Lancaster House next. This is Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's get now to high interest. Look at what's making headlines around the world. The U.S. is no longer wholeheartedly endorsing an independent Palestinian state, according to U.S. Ambassador to Israel, Mike Huckabee. He said a years-long societal shift is needed before the option of a Palestinian state is realistic. He spoke with Bloomberg in an exclusive interview from Jerusalem.
Someone wants to declare that this is the exact strip of geography that is going to be the future Palestinian state. That's where the complication comes from.
Well, maybe the word is exact. That's the problem. Are you suggesting that somewhere other than mandatory Palestine area that it could be in Saudi Arabia or something? Or are you suggesting?
I'm just saying that I think every option should be and could be on the table.
Huckabee, of course, a former governor of Arkansas who's previously been an advocate of Jewish settlements in the West Bank, which are, as we know, considered illegal by many states and international agencies. President Trump ordered the mobilization of 700 Marines to Los Angeles to break up demonstrations against his immigration crackdown. The turmoil comes as LA saw a fourth night of clashes between police and demonstrators rallying against a rising number of raids by immigration and customs enforcement agents. California's Governor Gavin Newsom called sending in the Marines, quote, a blatant abuse of power. The protests are spreading beyond California with rallies in San Francisco, Chicago, Washington, and other major American cities. The White House said it will not tolerate an insurrection that puts law enforcement's lives in danger. Meanwhile, Defense Secretary Pete Hegseth will testify before a House panel today. It's his first time on Capitol Hill since being sworn in 5 months ago. He's expected to face tough questions on defense spending and signal chat leaks, but overshadowing much of that testimony will be the Pentagon's decision to send active duty troops to Los Angeles to quell recent protests, something that is normally considered illegal. And it's the second day of trade talks between the U.S. and China underway in London. Upon arrival, the Commerce Secretary Howard Lutnick gave us his gauge on the negotiations ahead.
I've been all day yesterday, and I expect to do all day today. So we're going well, and we're spending lots of time together.
And that was Commerce Secretary Howard Lutnick speaking to our chief political correspondent, Anne-Marie Hordern. Anne-Marie joins us now live from Lancaster House. And Anne-Marie, my understanding is they went until about 8 p.m. London time last night. Start around 10 a.m. London time today is what was reported as well. So are we expecting any material breakthroughs, or is this really just going back in time to the agreement reached in Geneva last month?
Well, this is all about making sure they can go back to that agreement reached in Geneva. Remember, following the Geneva talks, we did see a bit of escalation on both sides accusing the other of reneging on what they agreed upon in Switzerland. About 10 days ago, the Treasury Secretary that said negotiations had stalled with China, and then we had that phone call between President Trump and President Xi Jinping of China, and that really marked the pathway to get to the talks today. Now, they went for more than 6 hours yesterday talking. They had about 2 hours of talks this morning. There was a break. And then just at the top of the hour, He Lifeng, the vice premier who's leading the Chinese delegation, came back into Lancaster House. So the talks continue now, but they bleed into the second day. And it is crunch time, at least for the Treasury Secretary, Scott Bessent, because he is testifying tomorrow on Capitol Hill in front of the House Ways and Means Committee. So he has to leave London within the next few hours to make sure he's back in Washington, D.C. So far, we haven't heard any breakthrough so far, just that talks are ongoing. But if they do get to something concrete, it'll likely look very similar to what they agreed upon in Geneva, which potentially is going to be the United States lifting some export controls that came on after Geneva, things like jet plane engine parts, some chemicals, and nuclear materials. And also, the United States wants to see an accelerated pace of licensing of rare earths and magnets, which China has 70% of the market. And that's critical for U.S. defense and high-tech industries.
So what do we know, Anne-Marie, about the willingness of the Trump administration to give China, high-tech, AI-capable microchips in exchange for critical rare earth materials that are needed for automotive production? Like, are we willing to trade a little bit of national security for some commercial success here?
Well, that's a great question. I think we're trying to figure out what the U.S. red line is when it comes to national security and it comes to export controls in the semiconductor industry. Kevin Hassett, the National Economic Council director, had said there will be an easing of export controls, but not high-tech advanced semiconductors like the H20 NVIDIA chip, which, by the way, was produced to be China compliant of export controls under the Biden administration. At the same time, the president said yesterday, basically leaving it open-ended, saying we'll see. So when they come out from these negotiations, and if we get something a little bit more concrete, we will actually understand where the U.S. red line is, and that is going to tell us how far they are willing to go in the future. Because let's not forget, this is the first inning of Trump 2.0 trade war with China. During Trump's first administration, when we had the Phase 1 purchasing agreement, the trade war started in 2018, and it didn't end, Matt, until 2020.
All right, Anne-Marie, thanks very much. Anne-Marie Horder in there, Bloomberg's chief political correspondent, of course, also co-host of Surveillance, flying around the world following these trade discussions for us. Coming up, Cole Smead of Smead Capital tells us whether U.S. stocks are a bargain right now as investors anticipate strong earnings growth in at least some of these stocks through the year. It's not clear to me, exactly where we're looking for strong earnings growth. Is just tech stocks?
I have an
Just
idea.
tech
Yeah,
stocks?
it's tech.
Yeah.
Tech. Double-digit growth expected there. Not so much in some of the stuff that Cole likes.
Not in the oil patch, right?
No, not necessarily. So we're going
financials don't really look.
No, really tepid pace of growth expected there. We're going to get into it next, though, with Cole.
Yes, this is Open Interest.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The U.S. earnings growth is there. We're seeing about 13, 14% earnings growth, but no one cares. Actually, U.S. quality stocks are the worst performers within the U.S. equity market and for the global market. Quality is on sale. The U.S. is on sale. The Sell America trade that we've seen for much of this year has made U.S. assets of the best value we're seeing per pound for pound for the earnings growth you're getting. So earnings growth is the only thing that's going to get you there.
That was Matt Miskin from Manulife. John Hancock speaking about earnings growth right now. And let's continue that conversation with Smead Capital CEO and Portfolio Manager Cole Smead joining us at the desk. Great to see you in person.
Good to see you guys.
So we think of you as a value guy. We know you like energy. We know you like financials. And we were playing around with 2025 estimated EPS growth. I believe we have a bar chart to illustrate the point. You take a look at what's at the bottom. It's energy, negative nearly 15% expected. You compare that to big tech up top at 20%. How do you square that into a bullish position in energy?
Yeah, the weird part is Wall Street loves earnings, and Wall Street analysts are really good at doing one thing, which is predicting quarterly earnings. That's what they're great at. It makes me think that as a child, if they drop too many things, they'll call out the number of things they drop, and their parents are like, you should be a sell-side analyst. That's really good. So I say that because ultimately, what's going on in the stock market right now is the returns, the cash returns on capital of the S&P are actually in decline. Now, why am I saying that? Because earnings, you only depreciate a small piece of your capital base. In reality, what do we know what's going on with AI? They are CapExing this at obscene levels. I'll use Meta, they're at $70 billion just this year. And so why I'm pointing that out is let's use a company, a cheap stock, quote unquote, to some value people like Google. Google's probably gonna do about $53 billion of net cash creation, but that's taking $73 billion of free cash and backing out $20 billion in stock-based comp. Wall Street doesn't count that.
Right.
So I point that out because on a business like Google, an asset light, one of the truly great monopolies in the asset light world is only actually producing about 16% cash returns on book. Now, what's weird about that? That's too low. That's way too low for a business of that size and that scale. You get that at 6 times book and 40 times free cash. I can go and buy oil companies that are producing 11 to 13% return on invested capital, and I pay less than invested capital.
All right, I got to wrap you up, but we're going to bring you right back. Cole Smead staying with us. This is Open Interest.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are, I think hovering is the word right now. I'm not supposed to say churn, but that's really what's happening in this market. S&P futures are up, but only 0.1%. NASDAQ even less than that. And the problem is the market is in waiting mode. It wants to see what the U.S. and China get out of their meeting in London. It wants to see the CPI report tomorrow. Really, I think, wants to see the 30-year bond auction on Thursday, as hard as that is to believe. By the way, Ford ringing the bell on the New York Stock Exchange, which is fairly interesting, but this is, I think, fascinating. Lincoln Electric is ringing the bell at the NASDAQ. The company's like over a century old. I think it may be 150 years old. It's been listed on the NASDAQ since 1995. Not only are they crushing it in the last 5 years, as I always check with my comp function, up 150%, in the last 30 years, they're up, with reinvested dividends, 5,000%. So absolutely crushing it.
Yeah, really electric performance there from Lincoln Electric. I had to. Let's talk about Meta, though. This is an interesting one. Not exactly up 5,000% today, but it's up slightly higher on news potentially that Meta is recruiting dozens of experts to achieve artificial general intelligence that theoretically can perform tasks as well as humans. As we talked about with Caroline Hyde and Mandeep Singh, this is a clear priority for Mark Zuckerberg, who is personally hiring the team and arranging desks to sit near him, which sounds a little bit intense. It was up higher pre-market, but still a gain of about 0.5%, Matt Miller.
All right, Apple's Worldwide Developer Conference, not that you would know it, it's happening right now. It's not impressing analysts on the street too much. As you can see from the stock here, it's up only 1/3%. Even though Apple has announced such exciting deals as advancing its already formed partnership with OpenAI and refreshing its operating system. So we'll continue to watch that. And in fact, Bloomberg Tech co-host Ed Ludlow, I'm going to say, went to it and then decided to leave. He's back in San Francisco. So Ed, so boring that you just peaced out?
Yeah, a little bit, but I would put it in the context of yesterday's drop on Apple being more substantive and significant than probably we discussed. Like literally one session a market does not make, but just go to 1 p.m. Eastern time on the tape. And when Craig Federighi, Apple's software chief, started speaking very early in the presentation, he said, "We have no updates on Siri. They will come later in the year," and stock goes straight down. So, I actually find the rebound today a little bit more interesting And the reality is this, that Apple has a much catching up to do in AI. None of the announcements from WWDC, other than third-party access to its own LLMs for developers, because that's important for Apple's ecosystem, moved the needle, and we are in waiting mode with it. And yeah, it underwhelmed, for sure.
All right, Ed, I guess that's all we need from you now. But we will stay tuned to your program today. Ed Ludlow, co-host of Bloomberg Tech, and there's a lot to watch in tech today, right? Because you've got Mark Zuckerberg apparently like hosting dinners to hire the 50 smartest people and sit them near him. At Meta, they also are investing $10 billion in an AI data startup. Plus, you've got TSMC's massive jump in revenue. I think it was a 40% jump
40% in Meta,
in one month. So there's a ton to watch Ed and Caroline for today.
Yeah.
But probably just not Apple.
But there's a ton to watch when it comes to us and the discussions that we're going to have.
Yeah,
so let's keep it going.
Yeah, Cole Smead is still with us here, CEO and portfolio manager at Smead Capital Management. And Cole, I just wanted to, we were talking during the break about this idea that now is a good time for aggressive, smart financiers in the oil patch to go and round up some of their maybe tired old competition.
Yeah, it's to use Boone Pickens' old line, you can dig for oil cheaper in the New York Stock Exchange or the Toronto Stock Exchange than you can in West Texas, okay? I'll give you a very recent example right now. There's a company up in Canada called Strathcona Resources ran by Adam Watrous. He's a very successful investor, counter-cyclical investor. He's out buying a business called MEG. They're both heavy oil businesses. What Adam just did is sold gas assets up in the Montney to buy heavy oil. That's interesting because the market seems to be really excited about gas for AI and electricity. So what is he doing? He's arbing even the difference in the gas to oil market. So he's doing that. People are kind of caught off guard, and really he's going to close that deal. It just shows you that the smart money is moving on this. Once the Hess deal with Chevron and Exxon gets settled out, whoever loses that will go after an asset. That looks pretty obvious. So we're going to continue to see consolidation. But again, the question is who wants to own and run the future and who wants to just kind of, watch their kids as they retire.
Yeah. So, okay, so we've covered energy. I also see when I take a look at some of the names that you're feeling good about, I see a lot of builders in there, which also caught my eye. We talk all the time about what a weird spot the housing market is in. What is the case for home builders at this moment?
Yeah, so there's about 5 months of supply and demand meeting right now, which is pretty historically normal. I'll give you a little stat. You'll see if you go out on X, you'll read a lot of these super bearish articles on housing and whatnot and write-ups. I call those bear porn, for lack of a better term. And they'll say, oh, look, we've never had more new homes for sale than at any point since whatever date, okay? You name the date. 75% of the new homes for sale have not begun being built or are not finished. So the idea that we have this plethora of new homes out there that are just unsold, it's just not true. I say that because 5 months of demand-supply meeting is on lower demand right now. So it's a very balanced market. People are as bearish as all get out in the space. And again, we still have this tight supply looking back. We have the same supply as in 19. That was a good time to buy a house. That was a good time to be an investor. Luckily, everyone thinks that affordability is going to kill the golden calf again. And we've made a lot of money betting against Wall Street on that before.
I'm interested to know what you think about cars, because I don't see a lot in your holdings, but I remember when you guys were into O'Reilly, for example, and I guess new car prices are so high that people are going to be buying used cars. They're going to be fixing up their old cars. Do you care about that right now?
Yeah, we've actually never owned O'Reilly. We've looked at it a lot in the past. O'Reilly, AutoZone, those have been wonderful businesses. Here's how I think about this. Main Street's going to beat Wall Street. That looks obvious to us. We don't think the S&P will make good returns. We think inflation will beat the S&P, okay? Now, I point that out because look at our fiscal budgets. What are we effectively doing? We're creating this buffer and stabilizing the economy. Where's that recession that we've been hunting for years? We're not very good at finding recessions, and we're not very good really creating them. Now, why? Government spending, okay? So the economic fears drove a lot of security prices. Housing, oil, consumer-oriented businesses, that's where a lot of security prices were driven in April. The low on the energy stocks was not the low of oil. It was the height of economic fears in early April. So I point that out because that's the opportunity. I think really meeting Main Street where it's at, but again, that has nothing to do with Wall Street. That has nothing to do with the bond market necessarily. We are handing out a lot of fiscal largesse, and so far you can't kill this economy, which is bizarre to say.
By the way, you and your father have always been kind of acolytes of Warren Buffett, and he is passing the torch now. Were you at the meeting? What do you think about that? How does Berkshire look to you?
So I was at the meeting with my dad. We left 15 minutes before the meeting ended. And we were out in the concourse, and we got there, and we looked at each other, just one of those things I'll never forget in my career. We looked at each other in kind of like a moment, and it was like, it's the end of an era. We just kind of looked at each other, and we like understood. Funny enough, obviously 10 minutes later, Buffett announced he was stepping down as CEO at the end of the year. But you know, we just kind of knew that mentally. And that's why I'd gone to the first meeting in maybe over 10 years for myself. So I think it is an end of an era. I think there's a lot of questions we asked there. Ultimately, you have the greatest investor of all time. Greg Abel's a very good operator. He's wonderful. I think one of the questions could be asked is, could he consolidate Oxy? Because he knows a lot about the FERC approvals that would be required for that, things of that nature. And they're not going to invest in the utility business. They made that very obvious. It'll be interesting to see where that goes. But again, for a long time, you've been able to compound capital at higher rates than other places. But look at what Buffett's doing. Buffett's arguing this is like 2000. And if I had my best guess, we're somewhere between March and August of 2000. We almost got back to the old high in August. Everyone just remembers this nasty bear market for 2 to 3 years. But there was a massive bear market rally 5 months in, and you know what happened? People got crushed. That's what this looks like to me.
Well, I'm glad that we're on the topic of Buffett, because this is one of the questions I had coming out of that announcement. You know, you mentioned that Greg Abel, obviously very competent as an operator.
Yeah.
He's not classically an investor like a Warren Buffett, like a Charlie Munger. And I wonder how you think about that as someone who so closely follows this company.
Yeah, if I was gonna, you know, it'd be great to sit down with Buffett. He's not gonna take the time. He's got less time, and you know, therefore, why would he sit down with me? Ted Weschler is who I'd really want to visit with there. I think Ted Weschler, if I look at, you know, what he's done in the past, what his style of investing is. Again, he has a middle markets M&A background. He has a financier approach to this. I think that's, you know, but then again, we're not allowed to hear from him at meetings or, you know, whatnot. He's done some select podcasts and done some select comments here or there. But Ted is kind of, you know, in the back 40 of the discussion at Berkshire. I'd love to see him up closer. But again, that's just because I think he's a really outstanding investor.
All right, Cole, it's always great to see you. Really enjoyed this conversation. That is Cole Smead of Smead Capital. Meanwhile, let's get a check on these markets and specifically the makeup of this rally, because the S&P 500, it's up a little bit more right now. We are firmly above 6,000 at the moment, higher by about 0.2%. You take a look at the breadth, it's pretty good. We have more than 300 names in the green right now on the S&P 500. You take a look at what's leading. Meta, as we've been talking about. Tesla, too, a little bit of a rebound there after a pretty bruising week. Apple, Eli Lilly. What's not doing so hot right now, you do have the likes of Microsoft and Berkshire Hathaway, funnily enough, as we were just discussing, down about 0.5%. Not big moves overall. Let's take a look at the sector makeup, though, because you see up at the top, for Cole Smead, we have energy up by 1.2% at the moment. Communication services, a lot of that is coming from Meta, Matt. And there's not too much on the downside. Again, small moves overall, but the losers of today at this moment are industrials and financials.
All right, so there's a picture of what the stock market looks like. 10 minutes into the session, it does seem like we're in wait-and-see mode, and there's a lot that could come out and move this market, especially on trade. And we're going to talk about that when we come back. Boeing has struck record deals as a result of these trade talks since Liberation Day. We'll discuss the pros and cons of the jet maker as a bargaining chip with Jefferies analyst Sheila Kahyaoglu. This is Bloomberg Open Interest.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real. How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Macerich is getting upgraded to a buy over at Mizuho. The firm says that the mall owner offers an attractive risk reward and highlights its productive mall portfolio. Next up, Wall Street upbeat on that yesterday news of Warner Brothers Discovery's separation plan. The stock getting upgraded to a buy over at Huber Research. Benchmark also says it's an aggressive buyer on the announcement, and also KeyBank calls the spinoff positive. Shares down a little bit today, but they had a big day yesterday. And finally, we talked about this a little bit earlier, McDonald's getting a double downgrade to sell over at Redburn. The firm says that weight loss drugs are suppressing consumer appetites and presenting an underappreciated longer-term threat. Matt, we think they're a little bit late on this call, but still, shares are down at 1.3%.
Yeah, I mean, it seems like GLP-1s have been out for a long time, and a lot of people who have them, so I suppose that could grow, right?
Yeah.
I still want to get a hold of some of those, but I was never going to go to McDonald's anyway. Let's talk about something else that's very big. Boeing has emerged as a bargaining chip for U.S. trade negotiators. The plane maker has been tapped for deals with Qatar and the U.K., while China has lifted its ban on Boeing's jet orders. This has sent the stock soaring in recent weeks and prompted an upgrade at Bank America. Let's bring in Jefferies analyst Sheila Kahyaoglu, who has a buy rating on the stock. And I guess, Sheila, there's really only 2 to choose from, right? The other one has already had an incredible run, up 175% in the last 5 years, whereas Boeing, like what we just saw, is all of its gains for the last 5 years. So is this the idea that they can play catch up now?
I don't necessarily think Boeing's a momentum stock, but this is a global duopoly where global air traffic grows at a rate of 6% per year, and the number of aircraft we need is growing, 10% CAGR through 2040, essentially, both narrow bodies and wide bodies. So we've underdelivered for aircraft over the last 5 years, given the MAX grounding, given the pandemic, and basically air traffic at the end of last year in 24 was where it was in 2019. So we've missed out on 5 years of growth. So we're sort of starting up on those deliveries. Boeing is gaining momentum in its 737 deliveries and its 787 deliveries, but they're half of what they were still at peak. And so that's what's providing the runway, and the share price up 60% since April 1st lows, given the tariff talks.
So you're positive on Boeing, but I'm curious to fold in the trade backdrop into all of this. It's day 2 of trade negotiations between the U.S. and China in London. We know that China has halted orders of Boeing, and you talk about this favorable backdrop and the momentum that they could gain and pick up going forward, but how big of a wrench could be this fact that Boeing is starting to be used as a negotiating chip?
It's actually a huge one. Aerospace is a $100 billion surplus in the U.S. It's one of the only manufacturing surpluses in the U.S. So we were on Bloomberg back in April, and one of my favorite notes we've written is how Boeing could be used as a positive chip in tariff negotiations. It's easy to buy a $70 million, $200 million aircraft and chip away at your deficit. China hasn't ordered a Boeing plane since 2017, but that doesn't necessarily matter. Because given it's a global duopoly, we need 1,700 new planes per year. So you could 50-50 that between Boeing and Airbus. China could take 15% of that demand and give it to Airbus, and Boeing still has other carriers it could pick up from. And the air show next week is a big catalyst for that.
Isn't this company just broken, though? I mean, they haven't been able to figure out space. They go like double overtime, triple over budget. They haven't been able to figure out Air Force One, to the point that the president has to go get a used plane from Qatar, and the 737 is just constantly a disaster. Like, the last great plane they made was the 747, and when was that? That was like in the 80s and 70s?
I don't know if I would call that 747 the last great plane. I would say the 787 is pretty awesome, but in general, I would say...
Last iconic plane that they made, right?
It's a global duopoly, right? So no one else could build planes. Embraer's out there. They have the regional aircraft, but aside from that, it's Boeing and Airbus that you have to choose from. So it's quite difficult building aircraft. The engine is the other big piece, which we are very bullish on GE as well. That stock is running 15% of targets. They're going to have an analyst day next week where we think they could raise guidance quite a bit and even double EBIT in our bull case scenario from 24
But Sheila, what has been the problem at Boeing? Do they have way too many employees? Do they have so much management that doesn't really know what it's doing? Do they need an Alan Mulally again? Like, what's wrong with this company?
So the stock has actually been performing since Kelly Ortberg took over in August. They had a bit of issues in the second half, given they had the strike. They hadn't negotiated a labor contract since 2008, so that was pent-up anger. But they've been doing well, and Kelly Ortberg and Stephanie Pope, who runs the commercial business now, really have been focused on 6 KPIs. So what makes an employee's life difficult? I think that's what we all enjoy, when somebody appreciates what makes our life difficult and fixes it, and they've been very much focused on that. I was in Charleston 2 months ago, and it was simplistic changes. Instead of reading an aerospace manual that might be outdated and difficult to understand, YouTube videos on how to assemble parts if you troubleshoot. So just simplifying things for the employee workforce is what we are hearing and seeing.
So Ortberg's turnaround plan, it seems like it's starting to bear fruit. You can certainly see that in the stock price. I do want to get your thoughts on the state of defense spending, because you cover Boeing, but you cover a number of other names as well that seem pretty reliant on defense spending. Lockheed Martin comes to mind, for example. And I mean, you think about all the wrangling going on over the tax bill right now. Going forward, what's your best guess as to what defense spending actually looks like?
We're not bullish defense. That's one area I come on all the time and appear very bullish on Boeing and aftermarket names and GE. But the one area I'm not bullish in my coverage is the defense primes. I only have one buy rating, it's LHX. The reason for that is, even though the defense budget has grown over the last 5 years, and no one would have guessed it would have essentially gone up 40% over the Biden administration, earnings are not growing for the defense primes. A lot of these contracts that are growing the revenues come at a loss position or lower margins, and that is really a deterrent to profitability growth and EPS momentum for these names. So yes, there's several top-line bullish catalysts, whether it's the budget, whether it's the reconciliation bill, whether it's European defense spending going to 5%, but the names have not been seen, they haven't been able to leverage that.
Yeah, I'm interested in who you think is going to be the beneficiary of like the German rearmament, right?
Two names, right?
And Canada apparently is going to build an army. So like, are they going to spend real money? Germany certainly looks like it's going to.
Yeah, I think I think that European defense names will go up to 5%, and 3.5% of that will be on equipment. where I think the spending will come into play is mostly missiles, not so much aircraft, because you'll pick the home team. So you might not pick it. F-35 backlog is okay through 2030. Nothing to say about that. But you might pick a Eurofighter instead of an F-35 because you want to support the home team. Where we think you could see beneficiaries of that is Raytheon Defense. They have exposure 14% sales to Europe, and as well as Northrop. We were just with the management team last week. They sell a communication system for missiles called IBCS. Their first sale was to Poland. They're working on 12 other countries.
Such an interesting turning of the tables when it comes to global defense spending. I mean, you talk about Germany all the time, and I mean, you compare that to how Germany classically has been when it comes to defense, and Europe as well. Just a fascinating discussion, Sheila. It's always great to see you. Really appreciate you making time. That is Sheila Kailayu of Jefferies.
And she's going to Paris.
Yes, she is.
To the air show. Guy Johnson will be going there. I imagine we're going to be getting a ton of coverage and a ton of red headlines out of the air show next week.
I hope so, because there is plenty to talk about. So we'll keep an eye out for those headlines. But coming up in the next hour, we have the CEO of Beta Technologies, which has accomplished the first passenger flight by an electric aircraft in the U.S. We'll discuss then. This is Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on in the stock market right now. Kind of in wait-and-see mode, like investors have their hands in their pockets. We're looking at gains. The S&P right now at 6,015, and the NASDAQ right now at 20,836. The interesting thing here is, and I'm going to call out my producer, Will Shaker has such genius ideas sometimes. This may seem like a little thing, but it's big to me. He put Novo Nordisk right here on top of McDonald's, which is great because an analyst from 2023 downgraded MCD shares on GLP-1 concerns. You see all the tech stocks up, Tesla, Meta, and Apple. Even Apple up 0.5%, as Ed says, rebounding from the drop yesterday. And then Stellantis right now gaining 2.25%. They're going to bring back the Hemi. Coming up in the next hour, Seema Shah helps us break down the winners and losers from trade developments. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Defense Secretary Pete Hegseth is getting an earful from lawmakers on Capitol Hill right now over the deployment of military members to Los Angeles to keep anti-ICE protesters at bay. Minnesota Democrat Betty McCollum.
The president's decision to call the National Guard troops to Los Angeles was premature, and the decision to deploy active duty Marines as well is downright escalatory.
Writing on Truth Social, the president says the city would burn if he hadn't acted. So far, so calm as the protests enter day 5. CBS's Maurice Dubois is in downtown L.A.
It has remained calm, but yesterday it got dicey. There were confrontations right here on these very streets. Huge law enforcement presence, officers trying to get control, urging people to clear the area. The Marines we just told you about, they're being charged with protecting federal property and personnel.
Police in southeast Austria now say a 21-year-old former student who never graduated used 2 weapons to open fire on a high school in the city of Graz today.
There are crisis management teams to help people, even for those who haven't been physically harmed. But still, there are several fatalities.
They say 8 students and a teacher were killed. The gunman also died. No word yet on a motive. Austrian Chancellor Christian Stocker has declared 3 days of national mourning. Pushback from medical experts a day after Health Secretary Kennedy removed all 17 members of the CDC's panel of vaccine experts. CBS News contributor Dr. Celine Gounder.
Removing the entire ACIP committee at the same time all at once is highly unusual, and it injects political instability into a process that's traditionally been nonpartisan, not political, and rooted in science.
As the Trump administration gets set to resume federal death row executions, the numbers are ramping up in the South. CBS's Jim Krasula.
4 executions are scheduled in the U.S. this week, with 2 of them today. Alabama, South Carolina, Florida, and Oklahoma are scheduled to put inmates to death this week. That would bring the national total of executions to 23 so far this year. There were 25 executions across the U.S. last year, according to the Death Penalty Information Center.
Satellite photos show the number of emperor penguins in one part of Antarctica has declined more than 20% over the past 15 years. Researcher Peter Fretwell suspects climate change.
If the sea warms up, that sea ice, which
freezes over every year and melts every year, doesn't last long enough for them to complete their breeding cycle or to molt properly. And that really gives them a lot of problems.
Dow down 20 as the World Bank sharply downgrades its projection for global output this year. This is CBS News. Seems a lot of people aren't having kids because it costs too much.
The UN Population Fund survey found most people want 2 or more children, but 1 in 5 say they will not have their desired number. They cited financial reasons, infertility, lack of time, or lack of a suitable partner. Demographer Anna Rockhurch.
It seems that the whole humanity currently is entering the era of low fertility.
The UN fears some countries will overcorrect like they did 40 years ago when they worried they had too many people. Now they're looking to boost fertility again. Michael Wallace, CBS News.
Scientists are studying a funny-looking light pink fish with orange gills, hoping it'll one day help humans regrow severed arms and legs. The axolotl, popular as an aquarium pet, a pop culture icon in video games, is an expert. The fish can grow back not only body parts, but tissue in the heart, lungs, and even the brain. The study in the journal Nature Communications today. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience, also streaming live on YouTube. Also, we are on the smart TV thing, the Roku's, all that kind of good stuff. You just have to search Bloomberg Originals, and that's where you'll find us. Alex Steele and Paul Sweeney, we are with you. Looking forward, we're going to check in with Tyler Kendall, Bloomberg Television Washington correspondent, to get the latest on the U.S. and China trade negotiations taking place in London. Julie Beal, Chief Market Strategist and Portfolio Manager, Kane Anderson-Rudnick, get her market call here. Ira Jersey, we're going to talk to him about interest rates and what the Fed might do in a couple of weeks. Then we're going to check in with Janet Lauren, Bloomberg Higher Education Financial Reporter. She's got a really interesting story about the University of Texas system. They're cashing in on AI, crypto, and power. Great story about how universities are trying to shore up their finances here in an uncertain funding world. Right now, let's kick it all off with John Tucker and a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by IBKR. Will U.S. oil production exceed 13.4 million barrels per day for April 2025? At IBKR Forecast Trader, the yes was recently at 39%. You can start predicting today at ibkr.com/forecast. Last trading day for this contract, June 29th. Major stock averages are higher at a little change, still waiting for any signs of progress in the trade talks between the U.S. and China. The Mag 7 index up 0.7%. You have Taiwan Semiconductor Manufacturing, the main chip maker for NVIDIA and Apple, reporting a 40% jump in May revenue. That's because customers pretty much stockpiled chips ahead of the tariffs. Those shares up to almost 2.5%. Mike Wilson at Morgan Stanley, meantime, remains bullish of stocks.
We bottomed in terms of the pain of that initial announcement and how bad those tariffs were. So unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
The worst performing stock in the S&P 500, let's go there. You've heard of them. J.M. Smucker. They say the tariff-fueled price hikes will weigh on their profit. Those shares down close to 12%. Paramount Global planning, we've got several hundred employees today. They blame a continuing decline in the cable TV industry and the broader economic landscape. Auto lenders are providing extended terms now with loans of 85 months or more. That's 7 years. It's another warning flag that affordability does remain the central topic when it comes to buying a car. Now, according to Experian, the average car loan is now close to $42,000.
Oh my God!
And the average monthly payment $748.
Wow, that's
a lot.
We checked that. Well, let me do the major stock averages. S&P 500 up 10, the Dow down 23. The NASDAQ 100 up 35 points. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
That's making my 2019 Jasper Subaru looking pretty good after that.
I'm going to try to keep my car on the road forever.
No kidding.
I mean, the average age of a used car astounds me. It's like 10 years or something.
It's older now
11?
because it's been stretched. Yeah.
Okay. Yep.
I mean, to be fair, we do have to do a lot of work on it, but anyway, it's only 6 years. All right. Thanks a lot, JT. Alex Steele, alongside Paul Sweeney. Let's get to some of the market drivers within the overall indices here. Bloomberg Cross Asset reporter Isabel Lee is joining us. All right, what are you looking at?
I'm looking at JM Smuckers. It's not a good day for the stock, down by 13%. So the company said U.S. tariffs that are increasing the cost of their coffee business would weigh on profit for the coming fiscal years, estimated at $1 a share. So Citi analysts said they were already concerned ahead of the results, but then when they heard the results, this was even below the most bearish outlooks that they had heard. So this is a big deal for Smuckers because it owns Folgers and Cafe Bustelo coffee brands. I don't know if you guys drink those.
Folgers? No, because I'm not my grandmother. Oh, like that. I was like, what you would drink? I just mean like for me.
By the way,
like
you're supposed to say J.M. Smucker is in a jam.
Oh, I see.
I see. Yeah, that was really, really
Never
great.
mind.
Okay. Nice age reveal here. So last fiscal year, the company generated a third of its revenue from coffee. And since June last year, Smucker already increased its coffee prices 3 times, and they're expected to boost them again in August. This is why I've been hearing a lot of people saying they have to find alternatives to coffee.
Well, to be fair, my grandmother would be 120 or something if she was still alive. So I'm just saying, that's what I think of Folgers. All right, let's go to McDonald's.
McDonald's. So this one is also in the red. Shares are down 1.5%. So this was after the burger chain was slapped with its only sell rating. We have Redburn Atlantic saying that the shifting consumer patterns due to weight loss drugs are cause for concern. So Redburn gave McDonald's a 2-notch cut from its previous buy rating.
This was a story 2 years ago.
I know, we saw this coming. Like, obviously, people want to be thin and maybe even healthy. Then they will cut down on fast food and sweets and donuts.
So this is what we were all worried about that didn't happen for the last year, and now it's happening.
I think it's because this is concrete. It's their first sell rating, and other analysts remain largely split. McDonald's has 22 buy equivalent ratings, 18 hold, and an average price target of 332. So the analyst there said that McDonald's can see as much as $428 million in annual impact to revenue. So it's a street low.
Number 2 with a Coke. It's been my order since I was 14.
This is actually true. So when we were in D.C., well, he went to Shake Shack. We were in D.C., gets to the burger, finishes it in 5 minutes, and we're eating the salad with the pita thins and the olives and the tzatziki. Anyway, we digress. And speaking of, Novo Nordisk.
This one is also interesting, but it's in the green, up by almost 5% or more than 5%. So that's the highest level in 2 months. And it comes after a report from activist hedge fund Parvus Asset Management building a stake. And this comes after we know that the company has really been struggling. And it seems like Parvus is interested in influencing the appointment of the new CEO. So Novo last month replaced its CEO, which shocked everyone because the company's culture is very close-knit. They've only had 5 CEOs in their century-long history. But now investors seem to be cheering the move because Novo's drugs are Ozempic and Wegovy. They've become household names, but they've struggled to just really make it big and compete with their rivals.
Very good, Isabel. We appreciate, Isabel Lee, very good. Thank you so much. We appreciate it. Talking about the markets here, and again, kind of a mixed market here, but let's get to what's going on down in Washington, D.C. We've got some pretty, I don't know if they're high-stakes talks between the U.S. and China. It feels like every time maybe they get together, it feels kind of high-stakes, but I'm not sure if anything's going to get done in terms of trade negotiations taking place in London. Tyler Kendall joins us here, Bloomberg Television Washington correspondent. So what do we know, Tyler, about these talks? Are there any expectations that anything concrete can come of them?
Yeah, hey, Paul. Well, the expectation really is that both sides are trying to make sure that they can ensure that the other side is going to live up to the agreement that was reached in Geneva amid allegations that they're both violating those terms that were reached then. And I spoke to President Trump yesterday, asked him directly how the talks were going, and he said that negotiating with China is not easy. And when I pressed him on whether or not he gave his negotiators any sort of limitations when it comes to export controls, he didn't rule anything out. And that's because export controls really are at the center of the discussion during these talks in London, as both countries put restrictions on products that the other needs. Now, the U.S. has signaled that they would be willing to perhaps loosen or lift some of the export controls, but that would be in exchange, of course, for assurances from China that they're going to speed up these export licenses when it comes to critical and rare earth minerals that are so essential to U.S. supply chains. People familiar do tell us that the U.S. would focus in on some of the new restrictions that we've seen put into place in recent weeks when it comes to some of the software related to AI chips, also jet engines, and perhaps some chemicals that China relies on too, that the U.S. has been restricting in recent days. So we're going to have to see how it ultimately shakes out. Alex and Paul, there's a lot of focus here on how the Commerce Secretary Howard Lutnick is part of these talks, and perhaps that indicates that the U.S. is willing to put those export controls on the table. But it's important to note that just last week we had quite the split screen here in Washington. As President Trump was on the phone with Chinese President Xi Jinping, we had Howard Lutnick on Capitol Hill testifying to lawmakers that he actually thinks there needs to be a stronger enforcement of export controls. So there is sure a lot to work out on that.
And at the same time, we were just reporting that J.M. Smucker's profit forecast was hit by U.S. tariffs. I mean, partly higher coffee costs, et cetera, but also U.S. tariffs. So some companies are already seeing the impact, and I'm wondering if constituents are talking to their representatives on Capitol Hill in a different way than might have been there, say, 4 months ago now.
Definitely. And there still is tariff uncertainty, even as there was a debate whether or not we've reached the peak of that uncertainty. And Bloomberg Economics actually does put into context how high stakes these talks really are, saying that if those levies that are currently in place remain in place, it has the potential to cut U.S. imports from China by 70% over the medium term. So we're still talking about some really big impacts here. Even with that said, the goal of these talks in London does not appear to really be bringing down those tariffs. It's also unclear if the White House would really give up that sort of negotiating leverage at this point, considering that this is going to be a much more wide-ranging, broader deal that they're going to try to negotiate down the line. Of course, for context, it took them 18 months last time to reach the Phase 1 China deal. This time, we're really talking about these export controls, these other issues that have been popping up, including, as you well know, China has raised concerns about the U.S.'s plans to revoke Chinese student visas, something that President Trump said last week wouldn't be an issue. He said that Chinese students would be welcome in the U.S., but at this point it remains to be seen how substantially the State Department would really change its policies that are going into place.
I wonder how the mood is in Washington, D.C. about potential economic headwinds coming from tariffs. For example, Troy Lutka, who's over at SMBC Nikko Securities, just sent out a note, and he's saying small businesses could be hit hard. And he's saying that unemployment as a result of tariffs could rise to 5.3% versus today's 4.2%. I think if that were to happen, a lot of folks out there would be voicing their concern to their representatives. Again, what's the feeling in Washington just about tariffs in general, economic uncertainty in general, Tyler? Are people starting to tire of this?
Well, lawmakers definitely are hearing from their constituents on this. And if you ask the White House often likes to point to that there are different parts of its economic agenda that they're ultimately pursuing here. Look beyond tariffs. That's why they also want to see this focus on the tax bill. That's part of why we are seeing that expedited self-imposed timeline to get it done by July 4th. White House officials often say that, yes, for example, we are looking at increasing the debt when it comes to the reconciliation package, but they're looking to stabilize that debt to GDP ratio. And that ultimately it's going to be this longer term growth, even if there's going to be some sort of shorter term pain. Now, whether or not that squares with the data that we get and how much pain consumers actually can get before we start to see a pushing back really does remain to be seen. But it is top of mind here in Washington as lawmakers try to do their part when it comes to that reconciliation package.
All right, Tyler, thanks a lot. Tyler Kendall joining us from Bloomberg. And to that point, the NFIB actually rebounded, increased for the first time this year. Taxes are still the single most important problem in the survey for the first time since the end of 2020. But nonetheless, the NFIB optimism definitely rebounded there. All right, coming up, we'll get the take on the markets. If we just grind around these levels, like for how long, eventually does that bring back money into the market? And what does that actually look like? Julie Beal, Chief Market Strategist and Portfolio Manager at Kane Anderson Rudnick, will be joining us. Plus, there's an auction today, Paul.
Oh,
it's a 3-year.
wow.
Oh, yeah. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, will be joining us on The Outlook. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with his Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Major stock averages mixed to little change. I've been saying this for, I don't know how many days. Still waiting for some word on trade talks between the U.S. and China taking place in London. Right now, you have 7 of the 11 major industry groups in the S&P 500. They are pushing higher, and we're being led by energy. Enphase Energy, best performing stock right now in the S&P 500.
Energy.
That is up 4%. By the way, have you taken a look at gasoline prices, speaking of tangentially?
No, because you're going to tell me.
No, it's really been jumping.
Has it?
Yeah, it's over $3 at the Wawa. Anyway.
Did you not watch my piece on gasoline on Wall Street Week on Friday? Because you can find it on YouTube, and it will help explain what your gasoline
after work
prices
Friday, what was I doing? Was I watching Alex's show, or was I on the beach?
Completely watch it on the beach.
Okay.
You got time in this next segment.
Meta CEO Mark Zuckerberg personally recruiting a new team called the Super Intelligence Group. He's so hands-on with this effort, he's even rearranged the desks at the company headquarters. The goal is to achieve artificial general intelligence, AGI. It's the idea that machines can do a lot of jobs, at least as well as humans. And a cybersecurity breach at United Natural Foods was the primary distributor for Whole Foods. It's disrupted deliveries, also forced the company's systems offline. S&P 500 up 13, the Dow down 5, NASDAQ 100 45 points higher. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out YouTube. Also on any of your smart devices and smart TVs, you can check us out on Bloomberg Originals as well. Again, I feel like I've given this market check for the last week straight at this time every day, and that is that the S&P is up 0.2%, volume's a little bit mixed, the NASDAQ is up 0.3%. Julie Beal is Chief Market Strategist and Portfolio Manager at Kane Anderson Rudnick. Julie, if you have the market holding up but not going anywhere, what are you supposed to do?
I think this is a pretty good time to make sure that everything you have is working the way that you want to, right? This is a good time to review earnings as they've come out and think a little bit about what's the forward-looking outlook. The biggest challenge, I think, in this market is the recognition that it's pretty emotional, right? So we've gone from absolutely euphoric at the beginning of the year to totally despondent around April, and now we're kind of in this place where it's euphoric from a valuation standpoint, but it's not feeling that way for most portfolio managers. And I think there needs to be a recognition of how far the market has moved, because that indicates that there is a lot of weakness. There's not a lot of conviction in where we're at.
So where do we go from here, Julie? Do we hide out in government treasury bonds? Do we just try to play defensive dividend-paying stocks? Or do we say, hey, everything's going to be all right. I can take some risk here because the market's really has whipsawed so far this year.
Yeah, I think right now still your best place is to be invested in the market and to be focused on quality, because you just really are not going to be able to predict any of the outcomes, right? I think we've all given up trying to predict. I think these poor economists on Wall Street that are having to revise their GDP weekly, it's a brutal job, right? It's like checking in with my 7-year-old like every 10 minutes is brutal. But I think that it's a real recognition that we really don't know the direction. It's very, very hard to gauge the size and the scale and the impact of what the tariffs are going to be, nor any of the tax policy that we have coming out. And so I think you're just really better served sitting very still in higher quality companies and trying to ride this out.
What is higher quality right now? Like, how would you define that?
For me, the highest quality businesses are going to be those that have very low levels of debt. That's absolutely critical when I think that, if you have a view that the long-term picture for interest rates is probably not going down materially in the near term, then I think it's really important that you have very, very pristine balance sheets. You need to have good levels of cash flow for businesses that are able to invest when things clarify. And then I think the most important thing is that you have a lot of durability to the earnings. I think I want to have a lot of clarity that regardless of what's happening in the tariff environment and the fiscal environment, that these companies are going to continue to do business. People are still going to want their services. They're protected from a competitive standpoint, because I think these are the types of businesses. They're not typically your flashiest, sexiest businesses, but they are typically the ones that are with you for the next 10 years with very consistent earnings trajectories.
Julie, do any sectors or maybe even factors screen well for you guys right now in this time of uncertainty?
I think that it's less about sectors, right? I think it's much more about within each sectors you can find good quality companies, right? So even within consumer discretionary, which for most long-term investors is a tougher place to play, you can find companies like an Ollie's Bargain Outlets, right? That's providing a lot of value for their customers and has more protections around it than your average retailer. If I think about tech, even in the space of tech, most of it is software is usually the place that I think has the greatest quality. But within software, you have to be very selective because typically the valuation is higher. So your margin of error is a little bit sharper and you have to be a little bit more careful.
There's a couple fun pieces out about how, say, PIMCO versus BNP are looking when it comes to the bond market, like the belly or the front versus the long end and stuff. How do you look at treasuries as a hedge at this point?
I think right now it doesn't make a ton of sense to me to be taking a ton of duration. I think you're not necessarily really getting paid for the level of uncertainty that you're taking on. You're getting a pretty nice, rich yield right now early on. And I think that is probably a better place to be. Even as an equity investor, I look at some of the yields people are getting on shorter duration fixed income, and it's sort of like, ooh, I got to be competitive. Like I really have to sharpen my pencil to deliver.
Is cash a bad place to be these days?
It's like I always think as a PM, I'm not really paid to hold cash.
Yep.
And I think that it's really hard to be able to predict when exactly the market is going to move in a certain direction. So, I typically have 3% cash in case I absolutely fall in love with a company and I want to be able to pull the trigger on it quickly. But typically, I really recommend being fully invested.
Yep.
It's difficult, right? In markets like this, you kind of want to have the sensation of, oh, I want to be ready in case there's a pullback. But when you look at your attribution, you see that even having a 5, 6, 7, 10% cash weight when the market is solid is a huge drag on your performance, right? I think you're better served to stay invested in things that, are higher quality like a treasury than just being in straight cash.
Right. Julie, thank you so much for joining us. Really appreciate it. Julie Beal, Chief Market Strategist and Portfolio Manager at Kane Anderson Rudnick, joining us via Zoom from Santa Monica, California. So some good stuff out there. Ira Jersey checks in with us. I'm not sure why we're talking to Ira Jersey. He's a U.S. interest rate strategist, Bloomberg Intelligence.
Okay, auction, dude.
Oh, man, we're not going to go there. But everybody on Wall Street wants to hear what Ira Jersey's saying. So, but I think I could do an Ira's job here. We're kind of range bound. A 10-year Treasury, I don't know, 4.25%, 4 to 3/4. Ira, it feels like your market, it's kind of range bound, which suggests maybe there's really not any conviction one way or the other. Is that what you're hearing out there?
Yeah, so it's funny. There's this push and pull of some people who think, oh, the economy is going to weaken significantly and there's going to actually be decent demand for treasuries, versus another group that says, oh, the fact that we're going to have higher deficits and continued with this fiscal largesse in the U.S., and that might push rates higher. You're seeing this push and pull between those two camps. That being said, the Federal Reserve also being on hold, maybe all of this year, according to the way the market's priced right now, does suggest that we just kind of hover around here, at least for the time being, unless there's a significant turn in the economy. And Friday's jobs data just, doubly proves that the job market is slowed, but doesn't seem to be slowing further. So therefore, in a steady state world with the Fed on hold and the economy fine but not great, the rates don't have to do much of anything really.
Okay, so we got the 3-year today, 10-year tomorrow, 30-year on Thursday. I feel like I don't quite remember a time when the 30-year was this talked about this far before the actual auction. How do you think things are going to go over the next few days?
Yeah, so the 3-year today will be maybe, from a foreign demand standpoint, maybe the most interesting, actually, because remember, the real angst back in April was as to what were foreigners going to be buying, were they selling? You saw a lot of volatility overnight in the Treasury market. So that's one reason why there was a lot of fear that, a lot of pension funds and private investors would stop buying the 30-year. But central banks and other policymakers, right, both fiscal agents as well as monetary policymakers globally, own treasuries in order to conduct their monetary and currency policy. So demand for the 3-year will be probably the key as to if the trade war and all of this other angst is really affecting the decision-making of those policymakers. The 30-year is mostly interesting because it's the most risk that we have out there on the curve, on the yield curve, because, you know, a little tiny movement in the yield of that moves a lot in price, right? And that's the what we call duration, the price-yield relationship. So when we wind up with so much debt coming out on the same day, you know, it has to be, you have to watch it. Last month's auction, though, went pretty well, so I don't see why this auction won't go okay as well on Thursday. So I'm really focused on 1 o'clock today right now.
How does who sells the government debt? Is that the Fed?
The
Treasury?
The
Treasury
How does the
Department.
Treasury decide which maturities to sell and when? How does that work?
Yeah, so every quarter they come out with what's called the quarterly refunding announcement. We had one about a month ago, and then we have another one in late July, early August. And when they decide, based largely on where demand is, right?
Okay.
So one of the reasons why they're issuing a lot of Treasury bills right now, there's around $6 trillion of Treasury bills outstanding, is because there's a lot of interest in short-end paper from things like money market mutual funds, which have $7 trillion in assets. So when you wind up having this supply-demand relationships as in favor of demand for those securities, the Treasury Department then comes out and says, oh, we'll issue more of those securities that are in demand. And you've seen that over time. It's usually pretty incremental. They don't just, you know, change things on a dime, but they do make incremental shifts based on who's buying what and where.
Wait a second. Is Paul going to start to buy into Treasury refunding announcements? Because this would be a thing. And then pretty soon he's going to start talking about debt ceiling impact and issuance, and then he'll start talking about auctions. I think we've corrupted him slowly.
Bid to cover ratio.
He's going to get into
Remember
it.
that?
Ira, I think we're starting to move him. This is huge. Hey, Ira, thanks a lot. Super appreciate you always. Ira Jersey, a Bloomberg Intelligence Chief U.S. Interest Rate strategist. All right, coming up, we're going to talk again about higher education and the drama that continues to unfurl. Apparently, oil-rich University of Texas is cashing in on AI, crypto, and power. We're going to break that down with Janet Lauren, Bloomberg higher education and finance reporter. In a market where broadly we're not seeing that much movement, but Charles McGilligot over at Nomura says that, look, if we continue to just have these little moves here, we're going to start to see the fund flows get back in, like CTAs, commodity trading advisors, and that will push the equity market higher regardless of any sort of fundamental news. And if volatility stays quiet, those volatility funds may need to come in as well. Volume, again, pretty mixed. This is Bloomberg. Happy Tuesday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Right now, the major averages are a little changed to higher. S&P 500, 16 points higher. That's up 0.3%, 6,021 on the index. So that would put it about 2% away from its all-time record. Dow Jones Industrial Average, 17 points higher. The NASDAQ 100 right now up 50 points. That is up 0.2%. Ahead of the auction, that's for you, Alex. The 2-year right now, 4%, pretty much unchanged. The 10-year yield, pretty much unchanged, 446. And then 30-year, what is that, tomorrow or later in the week? Anyway, the 30-year ahead of that auction, 493, Thursday. Worst performing, the S&P 500, J.M. Smucker down over 11%. U.S. tariffs and higher coffee costs reducing J.M. Smucker's profit forecast by roughly $1 share this fiscal year. Meantime, Matt Mishkin at Manulife remains focused on earnings growth.
We're seeing about 13-14% earnings growth, but no one cares. Actually, U.S. quality stocks are the worst performers within the U.S. equity market and for the global market. Quality is on sale. The U.S. is on sale.
And Citigroup set to put aside hundreds of millions of dollars more than it did last quarter to account for potential losses on loans and credit cards, a sign of likely worsening consumer health. And shares of Citigroup down just about 0.5%. Well, here's one for you. Human line judges are going to be absent from Wimbledon this year. Instead, they're going to have cameras. 12 cameras will stand courtside to call whether the ball lands in or out. The Grand Slam Championship opens June 30th.
Technology is awesome.
Fully adopt electronic line calling, courtesy of Sony's Hawkeye Innovations. There's also apparently a shortage of line judges since sports, even tennis, you can bet on it now online. They say it's getting increasingly difficult to do because they're getting all sorts of threats.
Really?
Even death threats.
And you know where the betting is? It's not in the big matches. It's on the second and third tier circuits where there's less. That's where the big betting is in tennis.
I believe it, 100%. Yeah.
So,
but that's where you get the upsets, right? Like the beginning of the upsets and all that.
So there you go. We check the markets for you all day long.
Yeah, you
right
do.
Here on Bloomberg. I'm John. That's your Bloomberg Business.
He did a little dance. That's why I said that. You have your tickets yet?
Yes.
You did? Okay,
Yeah, for
nice.
first Tuesday, U.S. Open. Boom.
Boom.
Arthur S. Stadium. John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Also on your smart TV. Search Bloomberg Originals. Janet Lauren, higher education finance reporter, Harvard reporter, joins us in our active studio today, but we're not going to talk about Harvard and the fight it's having with the U.S. government. This time we're going to go down to Austin, Texas, University of Texas, cashing in on AI, crypto, and power. Janet, how is the University of Texas system based on Austin? How are they benefiting from AI, crypto, and power?
Well, thanks for having me on. So I actually went to Midland, Texas for this story.
That is landman country.
Oh,
people.
yeah.
That is the patch.
Have you watched the show?
Oh, yeah. Have I watched the show?
That's where he's learned everything he knows about oil.
So the University of Texas system has land 2.1 million acres in the Permian Basin that the state of Texas set aside for higher education in the 1800s when the land was supposed to be worthless. But then something happened in 1923, struck oil, and for the first 100 years, the University of Texas grew its endowment with oil and gas. And now in the next century, they're looking for revenue from above the surface. They've started with a few wind and solar facilities. They have a crypto mining center, and they're looking to expand to, augment their revenue from surface ventures.
So that's so fascinating to me. How quickly are they diversifying? Like, how quickly is the money moving? And I wonder what policy in D.C. is also sort of filtering down into what the university invests in.
Well, the university actually isn't really investing in anything. They are the landholder, so they're signing lots of leases.
Sure, but they're like choosing to then maybe sign it for one part of energy and not another, one might say.
Well, they're looking to find new revenue sources. They've had a few wind and solar facilities on the land, and they just signed a preliminary agreement to lease about 200,000 acres or 10% of their land to a company called Apex Clean Energy for wind and solar, and their customers include companies like Meta and the Army and eBay. And right now these are, these things take years and years and years to build. The wind and solar facilities I saw that are up and running for a couple of years, those deals were initially signed several years ago, but it just takes time. And there's new transmission lines that were just approved in Texas, in 3 of them at $10 billion to move power into the Permian. So these wind and solar are producing them, and then these lines will be able to take them.
It's, Texas is such an interesting, place in the world for many reasons. One of which is when I think of Texas, I think of big oil, the oil rigs and cowboys and all that kind of great stuff. But it's also like one of the biggest renewables places. Yeah. I mean, they've got a lot of wind, and they got a lot of sun, and they got a lot of land. So how does Texas kind of balance those two things?
Well, they need an all-in approach.
Okay.
And the University of Texas has, really grown its endowment. It's, $48 billion, coming close to Harvard.
Yeah.
Wow. And I did a story a couple of years ago about their record year in oil. A few years ago, they got over $2 billion in oil and gas revenue.
That's amazing.
And it's just cash into the endowment.
Can other universities replicate the monetization of their land in a similar way? Like, what other universities have this kind of option?
Everybody in Texas knows never sell your mineral rights, but you can't really come close to this. I mean, Rice in Texas, they also have revenue coming from oil, from land, but nothing even comes close to this. University of Oklahoma, I did a story several years ago about, people gift them land, they keep the mineral rights. With fracking, they got, huge increases over time, but, you just can't compare anything to 2 million acres in the Permian Basin. So they are one of the largest, landholders in Texas.
Still, you have a great chart in here that just kind of shows the growth of revenue from their oil and gas business, which is still the vast majority of it. But this surface piece, it sounds like it can be totally incremental.
Yes, and the head of University Lands, which is the unit of the University of Texas system that runs it, initially he's saying we're kind of looking for a couple of singles here and there, test the waters, and now they're looking for bigger projects where they can have wind and solar power generation, on larger swaths of land to generate more money. Now, keep in mind, under these projects, the wind turbines that I saw, they have oil underneath, and that business is also working, so it's all concurrent.
All right, I have to ask you this question. Alice can answer it for you. There's a picture here, an operator flaring excess natural gas at a well at UT-managed land in Peyote, Texas. So there's gas escaping from the well, and they just kind of light it on fire so it doesn't go into the atmosphere.
Yeah. I mean, in theory, they want to capture it economically, because if you capture it, you can then use it. And also, with any sort of environmental restrictions, you got to capture it, but those restrictions are changing, let's say.
And down the road, maybe you can use that natural gas to power a data center.
It's like you got to make it economic, and if you can use it for something else, that's where you got it. Silly question: what are they using all this money for? Like sports teams, like what Paul was just saying?
Good question. So the money from oil and gas goes to basically building things. It's not for operations. So if you look at their campus, and we described in the story a couple of buildings, $50 million for Texas A&M's new business school, tens of millions of dollars for new hospital facilities. They run a bunch of medical schools, different types of technology within those medical schools and those health systems. I forget the number of schools between the two systems, but it's something like 20 plus, MD Anderson Cancer Center.
Yep.
So they build buildings.
They build stuff. We had John Mowry on, his CIO of NFJ, which is based in Dallas, a money manager, and he was just saying the growth of Dallas, it's always been a growth mode. But man, the last 10 years has just been extraordinary. And for so many reasons, the pandemic being probably one of them, but it's just amazing what's happening down in the state of Texas.
Well, and huge numbers of people are moving there. I think it's something like 1,300 people a day, and the UT and Texas A&M system are educating, hundreds of thousands of students.
Yep. All right. Wonderful story. Janet Lauren, higher education finance reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Really, really cool story. Another cool story about the amazing state of Texas. Oil-rich University of Texas cashes in on AI, crypto, and power. How about that? A little bit of green on the screen here today. The S&P 500 is up about 18 points. The Dow's at 52 points, and the Nasdaq's up.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday. Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are covering all the news for you: business, economics, finance, politics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries around the world. The news that broke around the closing bell yesterday was RFK Jr. removing all members of CDC vaccine advisory panel. So what does that actually mean for us, for the vaccinators, and for countries and health and all the things? So we go to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals. So if you get rid of a vaccine advisory panel, like what happens to vaccines?
Yeah, so Alex, this is, remember there's one group at the FDA who decides whether to approve a vaccine or not. So they do all the analysis on the efficacy and the side effect profile, risk benefit, etc. And then the ACIP, which normally meets 3 times a year, was the group that decides, or is the group, because it's not gone, it's just that the current members have been put aside and new ones are going to be brought on. The ACIP decides how to do it, how to take it forward, who should take it. Should it be, which is, what we've been having, those above 64, those above 50, et cetera, with comorbidity, without comorbidity, and how many times, et cetera. That's the kind of thing the ACIP reviewed and decided and gave guidance on that. And then insurance companies went on the back of that.
So, Sam, when you replace this entire panel, I don't think it's ever been done before, but my sense is, I don't know how quickly they repopulate this panel, but is there the risk that we see a slowdown maybe in kind of the distribution of medicines, new and existing?
Well, so I wonder whether RFK Jr., the head of the HHS, has already been thinking about this for the past 6 months, or say 6 months, since he was confirmed, or even before that. It is possible that he has people in mind for those roles. It is also possible that, and part of the reason for that thinking is that the June ACIP meeting hasn't been cancelled. So I suspect in the next week or so, we'll be hearing the announcement of the people who are going to be on the panel. Maybe we have to wait until that day itself. I think it's 26th of June, if I'm not wrong, or there or thereabouts. And so it suggests to me that the individuals have been chosen. Now, the interesting thing is that you usually get these folks picked and vetted, and it takes some time. So that's why I'm wondering whether some decisions have already been made. I don't know who would have made the decisions. Maybe Secretary Kennedy has done it himself. I don't know the details, but a group will be back. And of course, the question then is, who are they? What type of people are they? And are they all of the view that fits in with what Secretary Kennedy has been thinking, or what? We'll have to wait and see.
Okay, so let's play that fun what if game. Sam, if those that do come on do subscribe to views over vaccines as Secretary Kennedy does, what does that wind up looking like for vaccine stocks?
Yeah, as you can tell, I think Moderna is not really particularly suffering today, or BioNTech. I think the expectation is that this group will still be an expert group who will be able to decide how vaccines are administered and how they're used. And I don't think there'll be a particularly massive change to the already announced guidances and views, i.e. going forward we want placebo-controlled trials, i.e. we want these vaccines to be used in, particularly COVID, for example, in people with comorbidities and not just the entire population, etc., which has been what had ended up being happening anyway in reality. So I don't know whether there's going to be a massive shift. Then again, we wait and see who's on this panel. If they end up being non-experts in the vaccine world, then you start worrying.
So, Sam, as you talk to institutional investors around the world, what is their view towards biotech and big pharma, given maybe some of this changing landscape?
Yeah, so biotech's had a bit of a reprieve recently. As you remember, a couple of weeks ago or so, or 10 days ago, we talked about some M&A deals that came in, some big licensing deal, etc. So that has helped sentiment a bit. And I think what the market is not ready for is a real comeback on the most favored nation or anything to do with the tariffs on pharmaceuticals, because that's not gone away. All the other tariff conversation does not include pharmaceuticals, right? So there is a risk that we've become a little bit complacent, maybe, with regards to the sector as a whole and what the administration would do, maybe because of the walkbacks of some of the tariff talk that had happened with other sectors, etc. I think there's probably some of that happening. So fingers crossed, nothing shocking or surprising comes out of either of those two fronts.
Would we be thinking, though, that there would be some exemptions for some components, for some diseases?
Well, I think if there is going to be a tariff, it has to be on the imported drugs, right? Because then if you're a pharma company that produces 60, 70, 80% of your product in the US already, then you shouldn't feel an impact from that. And you might be able to then switch more manufacturing. But this is what I've said before. You can't say to pharma companies that the reason you should bring manufacturing here, because this is your biggest profit center. And then at the same time, with MFN, most favored nation, try and erode that profit capability. That's what I'm worried is one of the guiding principles of the administration.
Right, and that obviously has those repercussions. Hey, Sam, really great to check in with you. Sam Fazeli of Bloomberg Intelligence. He's Director of Research as well as Senior Pharmaceutical Analyst. Thank you very much. All right, for our listeners in the United States, here's a reminder. You can listen to us via satellite radio, Sirius XM, Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now as shocker. Stocks are higher, but volume is mixed.
Yes.
I know. I feel like this is a new statement that I'm saying.
It's the new normal, appears to be. And that's not too bad. That's not terrible.
I know, but then what? ...
Yes.
To the up or the downside. We'll break all that down for you. Happy Tuesday.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great hour lined up for you. Tom Orlik will be joining us. He's Bloomberg Economics chief economist on the latest in U.S.-China trade talks. Again, who has the leverage? Where might we see movement first? And Sarah McGregor, Bloomberg managing editor of the national team, will join us on the unrest and protests that are unfurling in L.A. Anurag Rana, Bloomberg Intelligence senior technology analyst, will be recapping the dud of Apple's WWDC. Can I call it a dud? I can call it a dud.
Well, just underwhelming, or I don't know.
I'm calling it a dud.
Okay.
I'm summing that up. All right, and then we will also talk to Joy Yang, head of index product management at Market Vectors Indices, to discuss her outlooks for the market. So we have a lot lined up for you. Let's kick it all off right now with a Bloomberg Business Flash with John Tucker.
All right, thanks, guys. And right now, the major average is pushing a little higher. Still waiting to hear what's going to come of the trade talks underway between the United States and China. Those talks taking place in London. S&P 500 within just about 2.1% of its all-time high. Designer Brands, this is the company behind DSW Shoe Stores. This is the latest U.S. company to yank its financial forecast because of uncertainty stemming primarily from global trade policies. Shares the trade in the United States of the chip-making giant Taiwan Semiconductor Manufacturing. They are higher right now, up just about 2.5%. The company said its revenue in May jumped nearly 40% from the year earlier. S&P 500 right now 15 points higher, up about 0.25%. We're at 6,021 on the index. The Dow Jones Industrial Average 58 points higher. NASDAQ 100 up 33 points. That's up about 0.2%. Victoria Fernandez at Crossmark Global doesn't see much immediate movement in stocks.
We are going to continue to kind of turn around these levels. We're at this 6,000 level for the S&P. It's reached that. That was a strong psychological level. And I think that's where we'll stay until we get news one way or the other coming out of these talks. You know, the market tends to get ahead of itself a little bit.
McDonald's right now down 1.3%. The largest restaurant chain is lower after Redburn Atlantic gave them the sole sell rating on this stock. They're blaming shifting consumer patterns due to weight loss drugs and inflation. And you may not have heard of them, Morelli Holdings, the auto parts supplier for Nissan, Stellantis, and other car makers. They're planning to seek Chapter 11 bankruptcy protection. Morelli employs more than 50,000 people. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Let's take a look right now at some of the stocks on the move today. I'm Paul Sweeney along with Alex Steele, and we're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at?
I'm looking at Paramount. So the stock is now flat, down by nearly just 0.2%. So the company plans to cut several hundred employees due to the economic landscape and just really the continuing decline in cable TV. I mean, now when I talk to a lot of my friends, not many of them have cable TV, and the move will affect 3.5% of the media company's workforce, according to an internal memo. So Paramount, which is the parent of CBS and MTV, last year already cut 15%. So now majority of employees will be notified immediately, says the CEO. This is just really, I think, a challenging time.
Yeah, I've seen this before, as has John, in the newspaper business, in the magazine business, in the radio business, and now the cable television business.
Well, also, it's sort of like those industries don't disappear. They just radically change.
Yes.
So there's only going to be a few players in a very particular kind of content, right? And the different people that work there and different needs. So it's sort of like how to rethink that.
Yeah, it's just, there still is content creation. There always will be content creation. It's just a question of how it gets to the consumer. And now it's direct to the consumer via streaming.
Okay, let's go to Apple. So I called WWDC, the Worldwide Developer Conference, a dud. Was that fair of me?
Probably. It's up. The stock is up 1.5%. AAPL is the ticker. So Apple introduced a number of AI-powered features during that conference. And even after investors are really waiting for the enhancements to Siri, which is their assistant, AI assistant. So the announcement included an expanded partnership and a relationship with ChatGPT, which is ChatGPT maker OpenAI, which first teamed up with Apple last year. And AI wasn't really the main focus of the event, which is why maybe Alex thought it was a dud. It dwelled more on operating system design changes and other features. But they did talk about AI and how AI capabilities will help Apple's iOS begin to match more features offered by Samsung and Android devices. This is always a debate with me and my cousins. I have an iPhone and they have an Android. And we always have a contest on who will take better photos or like features and stuff.
And?
I'm just a lifelong Apple user, and I think that's the strength of Apple. She's very sold on her Android. It does make you pretty.
Our family is all Apple,
It does,
with the
see?
exception of my oldest son. He's Android, and he's the engineer, and he says it's a superior technology.
Exactly.
I'm like, all right, dude, but the rest of us are on our little Apple group chat, and where are you?
So wait, the Google or Apple phone gives you better pictures?
Yes.
Google or Apple?
Better
which
as
one?
in prettier.
Yeah, no, I'm into it, but which one?
The everything except Apple, because Apple is so clear. You see your pores and you see your imperfections, and you don't want to see those.
So as I get older,
No, I think
then
it's
maybe
Android.
I switch.
Look,
but you've
see
invested
this
in your
picture I
face.
took the other day?
I have invested in my face,
That's a
but
great
you know,
picture.
girl can always use some help.
It's not an Apple phone.
For those of you not on television, John Tucker has a picture of some birds. Okay, let's go to Meta.
You really described that well.
Let's go to Meta. Investing even more in AI in a particular way. Great story from Bloomberg News.
It's an exclusive. It's a very fantastic story, but shares are up just 0.5%. So the tick here is Meta, META. So Mark Zuckerberg is assembling a team of experts to achieve artificial general intelligence. So he's recruiting from his home in Lake Tahoe and Palo Alto, and he aims to hire around 50 people for the new team, including a new head of AI research. He even rearranged desks at his office in Menlo Park so that the new staff will sit near him. So those are all details from this fantastic Bloomberg story. So it's been said that Zuckerberg has been frustrated with Meta's shortfall in AI, and I guess now he's really planning to take action. And he is building the team in tandem with a planned multi-billion-dollar investment in scale AI. So I'm surprised that the shares only popped by 0.5%, but maybe it's
They've
because
already had a nice run.
yes, and it's all talk for now, maybe, and
Yeah,
we'll wait to see.
I'm just glad he's not talking about the metaverse. That was a soul-crushing experience for shareholders.
It really, I mean, it really was. It's just a matter of like how quickly this can all sort of move. All right, Isabel, thanks a lot. Bloomberg's Isabel Lee joining us. For more conversations just like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports and the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere that you listen. All right, let's go down to D.C. right now. Tom Orlik is Bloomberg Economics chief economist joining us in the state of U.S.-China talks. Tom, knowing how much you do about both the Chinese and U.S. economy, which economy needs a deal more?
So the existing relationship, the pre-tariff trade relationship, was more beneficial to China than it was to the United States. China was the country with the trade surplus, so a direct contribution to growth. China was also benefiting from tech transfer as global businesses set up shop to produce there. So China is the economy which has the most to lose as that trade relationship now sharply deteriorates. This is also not an amazing moment for China because, of course, they're grappling with this slow motion collapse in their property sector. And that's a moment where you really want exports, external demand to pick up some of the slack. Not happening.
Tom, you lived and worked in Beijing for many years. You have a wonderful understanding of what drives the economy, what drives the politics in that country. Can you give us a sense how much do you think China needs eased trade tensions or even a big trade bill? How much do they really need it, do you think, vis-a-vis the U.S.?
So I think that the Chinese side have kind of conflicting impulses here, Paul. On the one hand, from an economics perspective, they're the country that has the most to lose if the trade relationship with the United States breaks down. And this is a moment where they really could benefit if external demand was providing a little bit of a boost to growth. On the other hand, China views itself as a great power, a peer competitor with the United States. And from that perspective, They absolutely don't want to cave, don't want to signal that they are susceptible to pressure from the United States. And it's those conflicting impulses, the desire to get a deal, but also the desire to save face, to be treated with respect, which I think are kind of going to be a complicating factor in these negotiations currently taking place in London.
Who do you, going forward, what kind of situation do you think the U.S. and China will find themselves in? One of somehow cooperation with many deals that will wind up continuing to move them towards working with each other, or a continued decoupling?
You know, I think it's steady state conflict, right? It's steady state conflict. What do I mean by that? Well, it's in neither side's interest to completely decouple, right? That's why in Geneva, it was pretty quick. It was pretty easy to get down from those embargo level 145% tariffs to something which was much lower. But then neither is it in America's interest to play nice, right? America's very worried about China's rapid catch-up. They're very worried about forced tech transfer. And of course, President Trump has demonstrated that tough on China is a real vote winner. So at one extreme, neither side wants to completely decouple. At the other extreme, certainly in the United States, cooperation with China, friendship with China, not really on the agenda. Where does that leave us? Somewhere in this kind of messy middle where conflict and tensions continue, but hopefully they don't ever blow up to complete decoupling. That to me seems like the bouncy, volatile equilibrium we're going to be in for the next few weeks, months, maybe even years.
Tom, describe the position for President Xi. It seems like it is unassailable. Does he enjoy full support of the Chinese people? And will that be reflected in policy?
So, I mean, Paul, I don't need to tell you this, but China is not a democracy, so it doesn't have elections, but it does have politics, right? The implicit bargain which the Chinese Communist Party has made with the Chinese people is you give us control and we will give you prosperity, right?
Yep.
Now, for decades, from Deng Xiaoping to Jiang Zemin to Hu Jintao, that bargain kind of worked, right? It kind of worked. Prosperity continued to increase, and no one questioned, with some notable exceptions, no one questioned Chinese Communist Party's rule. What's happening now? Well, the property sector's in a slow motion collapse. That's not contributing to prosperity. Trade, well, at one point in the last few weeks, China faced a near embargo on its exports to the United States. So exports weren't contributing to prosperity either. So how strong is support for the Chinese Communist Party? I don't think anyone really knows, but I can tell you that if property continues sliding and trade continues sliding and prosperity for Chinese households starts eroding, well, that's not going to be something that contributes to political stability.
All right, Tom, thank you so much for your time. Tom Orwick, Chief Economist for Bloomberg Economics, based down there in Washington, D.C. Let's go from D.C. Out to L.A. What's happening out there with the unrest out there in Los Angeles? Sarah McGregor, Bloomberg Managing Editor of the national team, joins us here. Sarah, can you give us the latest reporting from Los Angeles? We understand President Trump has authorized another 2,000 troops in addition to 700 Marines. What's the status?
Yes, so on the ground now, we're told there were hundreds of National Guards yesterday. That's moved up closer to 2,000 with, as you said, another 2,000 authorized on the ground. We are hearing that the 700 Marines are in LA right now. We're not being told their positions. And from what we're seeing from local reporting or what our own reporters are seeing on the ground, they haven't actually been deployed yet. So we're not seeing them. But I think the key question that remains is sort of what are their marching orders? Who are they reporting to? Is there coordination with local law enforcement, and sort of how will they react on the ground in terms of trying to control potential protesters? We did see a fourth night of sort of localized protests in Los Angeles. And again, these aren't massive protests. In some ways, it's, you know, vandals looting shops and obviously interacting with security forces on the ground. But these aren't massive protests yet that we're seeing in LA.
Well, that's exactly what I wanted you to paint a picture of, because always when you look at pictures, you're always going to look at the worst pictures, right? Because that's what we do as a media culture. What's it really like? How peaceful? Where are the breakouts of stress? What does the unrest actually look like?
Even before this weekend, there were peaceful protests in downtown LA, other parts of the city, mostly people focused on, immigration, anti-deportation protesters. So, this is something that isn't unusual, people gathering to sort of protest ICE raids or Trump's immigration agenda. Of course, the violence that we saw uptick over the weekend after a spate of raids in the area is what sort of prompted this latest flare-up. But that being said, what we're seeing right now, both from our reporting and local media, is that downtown LA, parts of South LA, Compton, Paramount, and now Santa Ana, which is in Orange County, are seeing some of these protests. So, we're in Century City, our office here at Bloomberg in the business district. That's you wouldn't know anything that is happening. It's miles away from some of these protests, Santa Monica, beach areas. So, it's kind of, it shut down a highway over the weekend. Again, I don't want to downplay the severity in some respects, but much of the city, if you didn't turn on the news, would not know this was happening.
Wow.
What's been the response from government officials in the state of California?
We saw quite the war of words between Newsom and Trump yesterday. We saw Trump suggesting, he wouldn't mind if Newsom was arrested. Of course, there's no grounds for that. But kind of back and forth. Newsom posted photos of some of the National Guard sleeping on the floor with their backpacks, saying, they're not being treated even properly. They're not getting food or a place to rest their heads. So, there's a little bit of theatrics going on with the war of words playing out over social media. But at the same time, there's some real issues at play. And I think, the escalation with the Marines yesterday is just another example of how, action is being followed up by some of these words. And Trump in the past has threatened federal funding to the state of California. So that's one of the big things that we're watching for. At what point will this escalate, potentially to more of a militarization, but also potentially funding cuts or other, other things.
Okay. Sarah, thank you so much for joining us. Appreciate your reporting from Los Angeles. Sarah McGregor, National Team Managing Editor for Bloomberg News, joining us from LA via Zoom. Red headline, crossing the terminal. The U.S. and China have concluded trade talks in London. That's according to a Chinese media. We'll bring you continued reporting on that. Seems kind of a quick session or a quick couple of days, maybe.
I mean, they kept doing it, right? It
Yep.
doesn't seem like it ended necessarily poorly. We don't have any more reporting on that, but we will definitely keep you updated. So full 2 days of talks there between the U.S. and China delegations in London. Okay, coming up, we are going to have much more on the markets. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst on Apple, plus Joy Yang of Market Vectors Indexes. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. And we are being brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. And this is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. So we did get that headline from Chinese media, U.S. and China concluding those trade talks in London. No word on any sort of deal, so the major stock averages a little changed. Right now, the S&P 500 up 15. That's a rise of 0.25%. 6,021. The Dow Jones Industrial Average 30 points higher. Nasdaq 100 is 47 points higher. That's up about 0.2%. The bonds are a little changed after a 3-year note auction, the first in 3 offerings that will end in Thursday's sale of 30-year debt. Also waiting for inflation data. Tomorrow, the Consumer Price Index, and that is followed by the Producer Price Index. Some of the individual movers, Cisco Systems updating its networking and security products, trying to make artificial intelligent networks speedier and more secure, part of a broad push to capitalize on the AI spending boom. And Taiwan Semiconductor Manufacturing, the main chip maker for NVIDIA and Apple, reporting a 40% jump in May revenue. That was front-loading ahead of tariffs. The Taiwan Semiconductor shares in the U.S., they are 2% higher right now. With the rise of artificial intelligence and the popularity of online classes, this has led to an explosion of financial aid fraud, fake college enrollments. Well, apparently, they've been surging. A crime ring has deployed what they call ghost students. So they take out loans and then steal the financial aid. And in some cases, this is an interesting story, the AP did it. In some cases, professors show up for class and there's no students in it, even though the class was pretty much sold out. They're all ghost students. Anyway, check the markets view all day long, right here on Bloomberg. I'm John Tucker.
John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, and we're also doing the Smart TV. That's also the video stuff, and you can just go search Bloomberg Pursuits, and that's where you'll find us. I'm just going to talk, or we're going to talk about Apple here. And I'm just going to go to Mark Gurman's reporting here. Why not? That is the place to start. Apple unveiled the most sweeping software redesign in its history, aiming to make the company's device lineup more cohesive and useful, even while doing little to upgrade its struggling artificial intelligence platform. I'm looking at the stock. It's up 1% today, but it's down 18% year to date. So kind of underwhelming might be the term. Anurag Rana joins us. He's the professional. He's a senior technology analyst for Bloomberg Intelligence. Anurag, what's your takeaway from kind of what we saw at Apple's developer conference yesterday?
Yeah, and you know, it's a lot of fun reading Mark's stuff because Mark always publishes what's going to happen at the conference a few weeks ahead. So we have time to learn and figure it out. But, you know, just like what he said, I mean, this was not a whole lot of things when it comes to AI. It's not going to force anybody to run out and upgrade their devices anytime soon. But, you know, one of the things that really caught my attention is the iPad software, how close it's getting to MacBook. That's an area where I'm not a big iPad user because I really want to use, you know, multiple windows and the way things flow with each other. So I use the MacBook Air. But I can see myself transitioning over to iPad that, you know, if you want to watch the TV or anything, you use the iPad. Otherwise, when you have to work, you just, you know, use that. So there were a lot of small things that make it shows that they are making incremental progress. But again, as you can imagine, everybody wants to talk AI and nothing else at this point.
So there are two schools of thought, right? One is like, look, they got 1 billion users, so at some point they'll come up with their AI, people will pay for it, and it'll be fine. The other is that they're going to be losing ground really quickly to other hardware suppliers that have different types of AI. Where do you stand on that?
I'm on the first camp. I don't think you can just move over from your computing device and go somewhere else. I mean, I don't even call it phone anymore. I mean, it is so much more than that for you. You're spending several hours a day on that particular phone. I think the AI strategy is pretty interesting for them because they control the distribution. They don't want to unlock or they don't want to let go of your private data while trying to figure this out. And I think that's a bit of a handicap for them, but I'm sure smart people, they'll figure figure it out. I think they're going to outsource a lot for others to figure it out as well. So that's also happening. And the third thing that it hasn't happened, but I'm fairly optimistic that over the next 12 months that they will add, Google's Gemini model also into their ecosystem, in addition to the OpenAI that's already there, because that will help them, gain more, you could say, expertise, features that they don't have, plus also show the regulators that they are not only just, married to one particular person for that feature.
Now, this is sacrilege, what I'm about to ask, Anurag, but I'm going to do it. Would they consider acqui-hire, buy their way into AI?
It's a very difficult thing to do because it's not so much that, everybody can use these. Everybody would be dying to put their model on the ecosystem. This is the most lucrative ecosystem for anybody that's out there. Over 2.5 billion devices and over 1 billion phones. So, from a distribution point of view, these are rich people who have these phones. They really are the ones who are doing transacting ecosystem. The problem over here is, when you look at somebody like a Google Gemini, it knows everything about you because, you feed it through search, Gmail. Apple keeps your data private. It's not seeing what you're doing on a daily basis. But if it's not seeing that, it's not able to give you customized stuff. It's not taking your data, sending it to ChatGPT and figuring it out. So it becomes a little bit tougher for them from a tech point of view, but I think over time they will get it.
I do have to say, talking to people, just humans, like outside of Bloomberg, for example, they use AI all the time.
Yep.
I mean, pitch books, emails, I was shocked at how much productivity is being talked about. Anurag, thanks a lot. Really appreciate it. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst, joining us on Apple. Believer in those 1 billion users and what will happen with AI. All right, taking a look at the markets, talk about believing. I mean, it feels like a rally, I can say that, over the last few days. It's stealth, it's not aggressive, volume's a little mixed, but we keep grinding our way higher. Joy Yang is head of index product management at Market Vectors Indexes, and she joins us now in our interactive broker studio right here at Bloomberg. So what does this tell us? Is this a strong conviction rally? Is this a grind higher until we get bad news rally? How would you describe it?
I think we're all waiting for the headline bombs to drop, but I think investors should be cautious not to interpret a bounce with a bottom. And, taking a perspective year to date, developed markets, emerging markets are still up 15-20% compared to 2%. And we have to look at the bond markets and what they're telling us. The yield curve is steepening, so there's still concerns, even if there are tariff agreements around inflationary prices, around U.S. debt, around kind of this backing away from U.S. exceptionalism. So there's still a lot of cautious risks out there that we need to process, and we should have a broader perspective on a handshake versus enforceable agreements and, the long-term implications of what's going on. So I think overall people probably are adjusting to this new normal, which is, we're going to have a lot of policy volatility as well as geopolitical risks. So investors are now stepping into, other alternative assets, and that's why we're seeing Bitcoin, pretty much increasing all-time highs. We're seeing gold kind of like stabilizing, but we're seeing alternative gold such as silver, platinum. They're reaching all-time highs at the moment.
So do I just buy 10-year treasuries? Do I just buy gold? That's my version of hiding out? Or do I go to quality stocks? I have air quotes.
Yeah, I diversify away from, high-tech growth stocks. Look at quality, look at value, look at gold, but look at, relative value to gold, which is the silver, the platinums. Look at where policy shifts will be more optimistic, which is around rare earth metals, around, those are the things that governments are focused on and trying to create better regulation or more stimulus package. Look at defense. And we're seeing regulatory clarity around crypto markets also. So that's opening up a new asset class. So really think about diversifying away from just your core holdings.
I take a look at the VIX. grinding its way lower, but then you look at, say, the VIX 6 months out, and you compare the two, and volatility is still expected to be quite high on a relative basis 6 months out. What does that tell you? How does that change an asset allocation?
I think people are really the VIX is reflecting people stepping away and just kind of waiting around. And we've seen kind of this breakdown in correlations between equities and bonds. And we're seeing this changing volatility pattern in crypto assets too. So Bitcoin has been stabilizing in volatility, coming down in volatility, whereas some of these stock, whether you look at NVIDIA or Palantir, those volatilities are going up. So I think investors have to adjust to this new normal and to think about holding different types of asset classes as well as diversifying away from kind of the traditional core equity bond.
What do you make of Bitcoin? What's your crypto kind of call your shop? How do you guys think about it?
I mean, crypto overall is, it's a very broad asset class. Bitcoin definitely is maturing with institutional focus, and we've also seen recently flows into Ethereum. So as investors, diverse investors come into this ecosystem, you're going to see a change of what people are focusing on, which is less of the speculative volatility and more of the use case, whether it's store value or operating core layer one systems. They are ultimately going to produce value and perform differently from equities and bonds that may be subject to more of the macro risks that we're seeing at play.
Speaking of, quickly, Blackstone CEO Steve Schwarzman was talking about investing in Europe. Is the ex-US trade kind of where you want to be?
It's still a good trade given the valuation.
Oh, actually, trade or investment, I guess, is a better question.
It's still, look at the relative valuation. U.S. is still very expensive. There's definitely, rest of the world is pushing towards less reliance on U.S. exceptionalism, providing more stimulus into their own national industries and military defense. So that's going to increase growth opportunities abroad. And as we become, I guess, more inner or protect our own industry, competition will broaden elsewhere.
All right, Joy, thank you so much for joining us. Always appreciate it. Joy Yang, Head of Index Product Management at Market Vector Index's Bloomberg Interactive Broker Studio. Was a good place to be. What are you looking at, Alex?
Well, I'm looking at what we're going to talk about next, which is offshore wind.
Yes.
So, yeah, you
But
got
that's not-
excited.
Yeah, but isn't that the one that's really under pressure?
Really under pressure. But if you need an all-of-above energy strategy, why wouldn't that include offshore wind, particularly projects that are already underway?
Right.
But Oliver Metcalf of Bloomberg BNEF will be joining us for his take on what happens to offshore wind in the Trump administration and where it's still going to be okay to invest. This is Bloomberg.